Good morning, ladies and gentlemen. On behalf of the organizing committee, it's my great pleasure to welcome you to the third External Statistics Conference, organized jointly by the European Central Bank, Arwing Fisher Committee on Central Bank Statistics of the Bank of International Settlements, and Narodowy Bank Polski. This time we are meeting here in Kraków. We are delighted to host so many distinguished speakers, experts, and representatives of institutions from all around the world, and we truly appreciate your presence and participation. Before we begin the official program, let me briefly share a few practical and organizational details. The conference sessions will take place in this conference hall according to the agenda available on the conference website. Coffee breaks will be served just outside the conference area. The lunch will be served in the next room. Transportation to the dinner venue will be provided from the entrance to the hotel at 7:15. Please make sure you arrive on time. Should you require any assistance during the event, members of the organizational team will be available at the registration desk throughout the conference. We would also kindly ask you to wear your badges at all the time. Please note that the badge is required for access both to the conference and the evening event. Ladies and gentlemen, it's my distinct honor to invite the first speaker, Artur Soboń, member of the Management Board of the Narodowy Bank Polski, who will officially open the conference. Mr. Soboń, the floor is yours.
Thank you very much. Ladies and gentlemen, excellencies, colleagues from central banks, statistical offices, international organizations, academia, and the financial sector. It is my great pleasure to welcome you to Kraków for the third edition of the External Statistics Conference, a joint initiative of Narodowy Bank Polski, the European Central Bank, and the Arwing Fisher Committee on Central Bank Statistics at the Bank for International Settlements. It is a great honor for us to host experts from around the world at such a significant moment, a time when external statistics are becoming one of the key instruments for understanding the modern global economy. Representatives from more than 50 countries across 6 continents are participating in our conference. Today, the world is witnessing growing geoeconomic uncertainty. The restructuring of global value chains, geopolitical tensions, and the rapid development of digital technologies and artificial intelligence. The direction of trade, capital flows, and foreign investments are changing. At the same time, the importance of economic security, resilient financial system, and high-quality data for policymakers continues to increase. In this context, the implementation of the new Balance of Payments Manual, BPM7, published by the International Monetary Fund, is especially important. BMP7 marks the next step on development of external sector statistics and significantly broadens their analytical role. The new standards go far beyond purely methodological changes. They respond to the fundamental transformations taking place in the global economy, including the growing role of multinational corporate structures, the digitalization of finance, the rise of digital assets, and the new financial instruments, as well as increasingly complex international flow structures. BPM7 introduces a more integrated approach to analyzing international flows and positions. It allows better monitoring of global financial links, sources of systematic risk, and channels through which shocks spread across economies. By linking data on financial flows, valuation changes in assets and liabilities, and the international investment position more comprehensively, BPM7 makes it possible to monitor developments in the global economy with much greater precision. This is especially important in a time of growing geoeconomic fragmentation, higher volatility in financial markets, and the redefinition of trade and investment relations between countries. Under such conditions, external sector statistics become not only a tool for describing the economy, but also a foundation for effective economic policymaking, financial stability, and the early identification of risks to the global economic system. Modern international statistics are increasingly supporting strategic analysis, helping to identify economic dependencies, assess risk in global flows, and better understand the impact of geopolitical developments on trade, investment, and international finance. This is why the further development of external sector statistics and the implementation of new methodological standards are now profound, not only for statisticians and central banks, but also for policymakers, market participants, and institutions responsible for safeguarding economic security. The theme of our conference reflects these challenges. Over the next 2 days, we will discuss geoeconomic fragmentation and its impact on trade and foreign investments, new methods for analyzing global financial flows, the importance of data on FDI, the measurement of digital and crypto assets, the integration of fragmented data sources, the use of artificial intelligence in statistics, as well the implementation of the new BPM7 standards, which are shaping the future of balance of payments and international investment position statistics. We are truly pleased by the broad international representation of experts from central banks, international organizations, and research institutions. Your presence demonstrates that international cooperation remains the foundation of reliable and comparable statistics. I would also like to highlight the importance of the ESC Data Challenge Initiative. The engagement of young researchers and students shows that the future of statistics depends not only on methodology, but also on creativity, modern data analytics, and the ability to present results in an effective way. Clear and modern communication methods are essential when presenting macroeconomic statistics, as they make complex data more accessible and understandable to a wider audience. Visual tools, interactive dashboards, and digital platforms help translate abstract figures into meaningful insights, supporting better public awareness and more informed decision making. Better communication helps statistics stay meaningful, not only technically correct. Clear visuals, short explanatory notes, interactive dashboards, and tailored messages can show how external flows affect exchange rates, competitiveness, foreign dependency, and economic resilience, which is especially important when the underlying transactions are becoming more complex. It is also critical for building trust and preventing misuse. When external statistics are released with proper context, clear explanations, users are less likely to misread temporary swings or compare incompatible series. Statistical agencies can also respond more effectively to questions or criticism in fast-moving public debate. Trust, especially important for central banks, is compelling for effective monetary policy. Kraków, a city with a rich history and strong intellectual traditions, provides an excellent setting for discussion on the future of the global economy and international statistics. I hope that this conference will serve as a platform for constructive debate, the exchange of experience, and the development of new partnership. I wish you productive sessions, inspiring discussions, and many new ideas that will help us jointly develop a modern statistical system capable of meeting the challenges of the 21st century. I hereby declare the External Statistics Conference 2026 officially open. Thank you very much.
Mr. Philip Lane, the member of the Executive Board of the European Central Bank, is not able to participate in person in our conference, but he delivered a video address to be shown. Thank you.
On behalf of the European Central Bank, I would like to welcome you to this joint conference with the BIS and the National Bank of Poland. I participated both in the 2020 Lisbon edition and the 2024 Madrid edition of this series, and I would really like to have kept my 100% participation record, but the calendar did not allow it this year. In these previous events, I tried to lay out in my contributions some of the data challenges that face people who need to look at external statistics. But let me report that there has been some progress in recent years. So from a euro area perspective, the fact that we now have a separate breakdown for special purpose entities in the BOP IIP data is a good step forward. The fact that we now have experimental data on euro area portfolio investment debt assets using the securities holdings data we have at the ECB, again, an important advance in our understanding. And this allows us to break down the portfolio debt data by rating, grade, by sustainability type, including green bonds, and with more detail on currency breakdown. When I look more generally, the fact that now from the IMF, we have the BMP7 manual, and from the United Nations, the System of National Accounts 2025. Again, these are modernizing the underlying conceptual frameworks in relation to financial interconnectedness, in relation to globalization, and in relation to crypto assets. And in the EU, this will be implemented in 2030, which these days is not so far away from a systems point of view. When I look at the conference program that you will be debating between the next 2 days, some of the highlights from my point of view is to recognize that the external data are so important right now in understanding how geopolitical fragmentation may affect trade, may affect the organization of multinational enterprises, and it may change the nature of foreign direct investment. For example, in a world of tariffs, we may see more tariff hopping FDI. I think across the program, the importance of differentiation between the geography of international investment assets and the currency composition is conceptually so important. Again, in a world where maybe some traditional exchange rate dynamics are changing nature. The session on measuring the cross-border component of crypto asset holdings, I think it's very important given the intrinsic global nature of blockchain transactions. And let me emphasize, which I think has been something, I've been involved with in Ireland, but now more and more countries are recognizing that it's so important to use granular firm-level data to understand the BOP. And I think there's some very interesting work will be presented at this event. More generally, when I look ahead and when we think about what might be at the next conference in this series, I think looking at the complementarity between portfolio investment and FDI is very important in relation to also the ultimate owners and the ultimate liability issuers, understanding how to look through investment funds and special purpose enterprises is very important. I think from a euro area perspective, the fact that we know a lot of global funding is intermediated through Europe without necessarily affecting the euro area economy directly remains an ongoing challenge in terms of interpretation. And let me also, which I think I talked about before, do observe in a world of trying to simplify EU regulations and so on, and simplify data collection in Europe, I think there should be renewed momentum towards moving towards EU-level data for the largest multinationals, rather than having this incomplete perspective by going country by country. And again, I think it's important when we look at the agenda to bring together, which this conference does, the producers of statistics and the users, because that dynamic between the insights from the producers about what can be interpreted from the data and the perspectives of the users is so important. Let me also mention, I think in the conference, a very natural topic is how AI can be used both maybe as a supplement in terms of how to collect data, but also, of course, how to interpret the data that we collect. And let me also emphasize, although it's very natural to go country by country or region by region in terms of what the data can tell us, in the end, I mean, I think the overall prize is to understand the global interconnectedness. And I know in the program there's going to be material on this topic, because in the end, I think that the North Star, if you like, is a more complete understanding of how it all fits together in terms of the whole constellation of global linkages. So to my regret, as I say, I will be unable to directly participate on this occasion, but let me wish you the very best for this conference. Let me congratulate all of the paper writers and thank all of the discussants and panel members for their contributions. So best wishes for the event.
For the first session on the cross-border dynamics in the fragmented world, please welcome Professor Gian Maria Milesi Ferretti, who will chair the first session. Gian Maria, the floor is yours.
Oh, a lot of light here. Thank you very much for having me over. It would be great to have my panelists here. Since you've come to listen to them, I'm just the timekeeper. So just a couple of organizing details here. We have 90 minutes, and the program indicated up to 20 minutes for presentations, which would leave just 10 minutes for discussion. Since we have 4 very interesting papers, I would suggest that the speakers try to keep their presentations to something like 15 minutes or maybe 16, 17, so that we are able to entertain more than 2.5 minutes per paper for the discussion. So without further ado, please let's get started. I think, Piotr, you're the first of the present. No, it's Lawrence. Lawrence, please. I'm sorry to ambush you.
All right, thank you very much, Jean-Maria, for the introduction, and thank you very much for having our paper to the conference organizers, and thank you very much for showing up in such great numbers already for the first session. It's a great joy to be able to present our paper on geopolitical fragmentation and greenfield FDI. This is joint work with colleagues at the ECB, and the usual disclaimer applies. I'm not sure how to move the slides. All right, let's jump right into the motivation which brought us to conduct this piece of research. Ever since COVID, and in particular the Russian invasion of Ukraine, firms and now also increasingly policymakers are looking at friend or nearshoring to make supply chains less vulnerable to geopolitical tensions. And from a euro area perspective, this trend is particularly interesting, given that geoeconomic fragmentation of trade would particularly be detrimental for the euro area, given its deep integration in global value chains. And so we decided to look into the effects of geopolitical fragmentation on FDI, because a reconfiguration in global trade and value chain networks might be actually anticipated by changes in the global foreign direct investment network, as shown by a World Bank study in 2021. So in this paper we use data from a commercial provider, FDI Markets, which is associated with the Financial Times, and we investigate the evolution of greenfield FDI flows between a geopolitical East or China-centered bloc and a geopolitical West or US-centered bloc, and neutral blocs, which countries which are not associated with any of the two blocs. And we try to quantify to what degree bilateral greenfield FDI flows vary with geopolitical distance. So we think it's particularly interesting to look into this question because it's not a priori so clear what the expected results would be. Because on the one hand, firms might look at friend or nearshoring production to make supply chains less vulnerable, or to safeguard their assets from potential future violations of property rights. But at the same time, you might also think that firms could increase their investments in geopolitically distant countries because they might anticipate future trade tensions in the form of tariffs, and they might want to build up local production capacity to potentially circumvent these higher tariffs that might be coming in the future. So what we find in a nutshell is that we provide some descriptive evidence for increasing FDI between and within blocs in particular, and to neutral countries in response to anticipated trade tensions, as well as selective decoupling among large geopolitical blocs. The econometric evidence from estimating gravity equations shows that the overall effect of geopolitical divides on FDI is indeed negative and has gained strong momentum after Russia's invasion of Ukraine, and it's particularly strong for the euro area. So given the audience here, I thought it would be nice to spend more time on what's actually in the data that we use here, because these data are from a commercial provider, right? So we had to fall back on these announced Greenfield FDI project data that the Financial Times, via their platform FDI Markets, collects from primarily public sources, because these data provide very timely information on cross-border investment in new physical projects or expansion of existing projects, and follow a broad concept of greenfield FDI. They report investment level information for over 300,000 greenfield FDI announcements starting in January 2003 for a broad set of bilateral flows between 186 countries. And the flows are not small in size, so you can see that they accounted over the last decade on average for over 1% of global GDP. And these data also serve as the backbone for the greenfield FDI statistics that UNCTAD, for example, publishes. So let's take a closer look at what's in these data. On the left-hand side chart here, you can see that greenfield FDI inflows for the euro area based on FDI markets are much closer in terms of size and volatility to liability flows of the non-financial corporate sector compared to the overall liability flows, which are shown in blue here. And that's basically because the data are less subject to financialized flows, which are present in the overall liability flows, in particular in the last couple of years for the euro area. And the fact that these financialized flows play less of a role is also evident in the chart on the right-hand side. Here you see the geographic breakdown of euro area FDI assets compared between the FDI markets data and the official balance of payment data as recorded in the IMF's coordinated portfolio investment survey. And as you can see, the geographic breakdown is closely correlated. But one thing that stands out is that financial center countries such as Singapore and Switzerland, for example, play much less of a pronounced role as destination countries for euro area greenfield FDI than in the official BOP statistics. So, besides the timeliness and sectoral details that the data offer, the absence of these financialized flows is an advantage of the data. But there are, of course, also some disadvantages which are important to acknowledge. For example, the amounts reported are on total planned investment in the project, regardless of the source of financing. So they include things that would not be in official FDI statistics considered actual FDI. And then the investment flows are also not really tracked over time, so they're just recorded at the announcement date. And while there are some revisions, it's not clear that actually all of the announced money will flow. And in our context, the perhaps most important caveat is that the data do not record disinvestment flows. So these might be particularly important in the context of geopolitical fragmentation, but they are just not in the data, so that's one thing to keep in mind when we interpret our results. So keeping these caveats in mind, let's take a closer look at the data through the lens of geopolitics. And for the descriptive purposes here, we divided the source and destination countries in the data into geopolitical blocks. And we follow here the literature on this and define a US-centric and China-centric block based on information on how countries voted in the United Nations General Assembly, as well as other information such as bilateral arms deliveries, for example. And so in the left-hand side chart, you see that all greenfield FDI flows from the Western Bloc, and you can see that greenfield FDI flows within the Western Bloc have been on the rise since 2016 and are substantially above their long-run trend. And this contrasts with the below-trend decline in flows between the Eastern and Western blocs. The right-hand side chart shows that companies domiciled in the Eastern Bloc are increasingly investing in neutral countries, with a significant spike observed since mid-2022. So this suggests that Western companies are increasingly friend- and nearshoring their production capabilities. Indeed, you can see on the left-hand side on this slide that the increase in West-to-West FDI flows also coincides with the increase in the terms related to friend-shoring in company earning calls. And one thing that complicates the analysis here somewhat is that this friend-shoring might not be purely driven by geopolitical considerations. The chart on the right-hand side here shows that the adoption of the Inflation Reduction Act in the US seems to have strengthened greenfield FDI flows to the US. So what we see is that following the enactment of the IRA in August 2022, there was a notable uptick in inbound investment into the US, particularly in IRA-related sectors. But the good thing is that in our econometric analysis, we can somewhat control for that using fixed effects. So what about the euro area in all of this? What we see is that euro area greenfield FDIs follow the global trend of larger flows toward more aligned countries. And this is largely driven by increasing investment in the US and decreasing ones in China. So we also see that developments are somewhat heterogeneous within euro area countries. For example, German firms, mainly driven by the automotive sector, have increased their investments in China. But overall, euro area FDI flows seem to have been increasingly pulled towards the US. At the same time, we see some evidence of investments between geopolitical blocs. For example, on the right-hand side, you can see that there's evidence of Chinese companies increasing domestic production content in the EU. But this takes mostly the form of investment in non-euro area EU countries, and in particular Hungary. And this suggests that Chinese manufacturers might have been increasing their local production in anticipation of tariffs that might be to come. So to sum up briefly at this point, the descriptive evidence shows that FDI increased a lot within the Western Bloc of countries, but there's also evidence of instances where flows between blocs increased in anticipation of trade disputes. In order to get a more systematic answer to the question of how geopolitics shapes greenfield FDI flows, we ran some econometric exercises that I briefly present to you now. So what we did is based on two papers by IMF colleagues that you see mentioned on the slide here. So we sum up all greenfield FDI projects announced by companies headquartered in country I, in destination country J in a given year T. And our measure of geopolitical alignment is the block definition that I have already mentioned. Or alternatively, we use directly the geopolitical distance as captured by differences in UN General Assembly voting patterns which are summarized in the so-called ideal point distance measure by Bailey et al. We also control for other bilateral determinants which could affect greenfield FDI flows, such as common legal origins and/or language, or past colonial relationships, preferential trade agreements, and geographic distance in those specifications where we don't have pair fixed effects included. One thing that I already mentioned is that things that affect the attractiveness of a particular destination country equally for all investors, such as the general business cycle dynamics or incentives under the US IRA, for example, can be controlled for by including time-varying destination country fixed effects to some extent, which we do. And we also include these at the source country level on top. And as standard in the literature, we estimate a model using PPML methods. So as you can see on this chart, the regression results indicate that just by being part of different geopolitical blocs, greenfield FDI flows are reduced by almost 2/3 compared with being in the same geopolitical bloc, with the gap widening over time and becoming particularly strong in the last couple of years. So positive coefficients for the within dummy variable suggest that FDI flows between countries within the same bloc, either Eastern or Western, are higher than those categorized as other, so the non-aligned countries. In contrast, during the entire time span, the coefficients for the between dummy variables are generally smaller compared to those to the within dummies, sometimes even negative. And that's particularly the case in the last quarter here, as you can see, which is the end of 2025. So what you can see in this chart is the alternative specification in which we measure geopolitical distance directly. And we show here the coefficient estimates of this so-called ideal point distance over various subsamples. And what you can see is that the overall effect of geopolitical divides on FDI is indeed negative. you can also see that the effect of geopolitical distance on global and euro area greenfield FDI flows has increased since Russia's invasion of Ukraine. And for the euro area, the negative relationship became particularly more pronounced after this invasion. So this already brings me to the conclusions, which you can see on the slide here. So we see that greenfield FDI is increasingly shaped by geopolitical divides. Greenfield FDI has remained stable or intensified within geopolitical blocs, while it has recently decreased between geopolitical blocs, and the econometric evidence broadly confirms this. So with that, in the interest of time, I stop here, and looking forward to the discussion and the questions you might have.
Thanks a lot, Lawrence, and apologies if I didn't properly introduce you. Lawrence is an economist at the European Central Bank. And Jakub, the floor is yours now. And Jakub is here at the National Bank of Poland, and he will tell us about export dynamics.
Welcome, everyone. Many thanks for having me in the program. So when was the discussion about the users and producers, I'm definitely user of the external statistics. And taking the opportunity, I would like to thank for your work, that we have available some material to study, to answer policy relevant questions. I really appreciate this. Okay, so today I will focus, I will present the joint work with Paweł Galiński, who is in audience. And the paper is simply, because probably I will not have enough time to discuss everything, is about the novel approach that we propose to understand the short-run dynamics of the export. Okay, so what we do, we will try to use the VR structural vector autoregression models with zero and the sign restrictions to say something about the role or the nature of the short-run variation in export. Okay, so this is something which will be complementary to the literature which is investigating the large shocks at the micro level, because we, in this paper, are mostly interested what is going at the aggregate level. And what is new is that we think about the general linkages within the global value chains. So we may think about the forward linkages, how the demand on some global market is affecting through the value chains, and also at the backward dimension, when there are some disruption that lead to some shortages in imported inputs. So key findings that can be derived from our work is, first of all, that the role of the global shocks is extremely important, and we can compare this to the part of the literature that's documenting the welfare effect of the economic integration. But at the same time, economic integration in EU led to rising exposure to the global shocks. And we find also the large cross-country heterogeneity in the role of macroeconomic shocks. Some of the results are intuitive, for example, that the trade openness or the JVC intensity is increasing the role of the global shocks, while the one is, I think, new, that the large concentration of export-oriented production in production of investment goods is something that makes the global shock extremely important. Okay, so the basic idea for this paper will be that we will propose some distinction of the foreign shocks into two blocks. One which will be related to the close economy abroad, and the second which will be related to the global economy. So we will produce a rather three-block world of economies, and with this in hand, we will identify the shocks. Okay, so this is the motivation for us, starting with the larger volatility of the international flow, which is greater than the typical domestic variables. We know that from the 70s in Europe, mostly from 90s, there was a rising integration or more intensive integration within the global value chains. Most of the production of the tradables, durable consumer goods and investment goods is becoming fragmented, but not in a geopolitical way, but the production of this good is fragmented, so it's divided in a very specific stages of the production, and is dispersed the production over the different part of the global economy. We also take some insights from the literature on the role of the macroeconomic uncertainty, and also with the fact that the uncertainty can also be amplified through the trade linkages. From the methodological issues, we are between all the VL-based evidence, which is related to inflation and the short-run variation in the data of key macroeconomic variables, and something between the global VL models when there is some semi-structural linkages between the variables. Okay, so I will start with a brief discussion of the methodology. So we start with the standard VL models, and the key problem is how we will identify the shocks. So we will have 9 variables. Okay, so I will firstly introduce these variables. So this is IPD. So there are 2 types of the indices. The upper index is related to the part of the economy. D is the domestic, F is a foreign, so this is the, let's say, local foreign economy, and G is the global. So we will have a 9 variable, and here what we see the block exogeneity, okay? And we see that which variable are assumed to be exogenous. So the variable in rod E is independent from the variable from column J when there is a dot. Okay, so we have a almost block diagonal relationship. So what does it mean? It means that the domestic economy will not affect the foreign economy, and the foreign economy in general is not affecting the global economy. And the shocks that we are identify is firstly the domestic demand shock, then domestic supply shock, then domestic export-oriented shock, which is related to the intensive margin, as this is the technical shocks, then exchange rate, which is also very important in variation of the relative prices. Then we have the block shocks foreign and the supply shock for the foreign economy and the global shocks. And we also, in the last column, we have the global uncertainty shock that we will identify. Moving to the, of course, the shocks sometimes are constructed in the same way. So, for example, the domestic shock is rising both the prices and the production, but in a recursive way, we will assume that it affects a larger part of the economy. Okay, and this is the key variable, how we are measuring these variables. So we start with the domestic variables. For the foreign variables, we will use for EU countries the rest of the EU. Okay, so industrial production, for example, in a foreign economy for Poland is the industrial production in EU economies. In other EU countries, we take the example of the EU because we know that there is a single market, so there is something which goes beyond the tariff measures and so on. So this is for us natural choice to select this closest part of the foreign economy. And for the global variables, we'll identify with the prices and the volumes of the trade. Okay, so I will move to the result. So firstly, the impulse responses function. So we see that in general are almost the same. Okay, so very important thing is that the domestic demand is not driving the export, which makes sense. And the most persistent effect is from the global uncertainty. This is consistent with the literature on the propagation mechanism of the uncertainty using the trade linkages. And moving to what we would like to have at the end of the day. So the historical decomposition. Okay, so here this is weighted for 18 countries in EU weighted by the export. Okay, and let me compare briefly what was in Great Trade Collapse, which was after global financial crisis. So we see that the nature of the slowdown of the export there, it was mostly the demand nature. To some extent, it was also amplified by the global uncertainty, but the most important factor was the gold one, it was the global demand. Then the recovery was also quite persistent, and the same factor played important role. If we move to the COVID, then we see that the general nature is almost the same, but since 2022, the dynamics of the export was damped by negative supply factors. Okay, so this is quite intuitive since we have the energy crisis disruption without the supply chains. Okay, so if we compare country by country, we see a lot of the variation in the data. Okay, so sometimes it looks the same if we compare Poland and Germany, but let's look at the forecast error variance decomposition, in which we assess the role of the shocks for given variables. So here we have, for all the variables of the system, I will focus on a third column and the first row, and we see that the export is mostly driven in a proportional way by most of the identified shock. But this is after aggregation. So cross-country heterogeneity matters. And if we compare country by country, what shock plays the most important role for each country, then we see that there is a lot of the variation. And what we do, we try to investigate this variation. Okay, so we group the shock, because I know that we have 9 variables, 9 shocks. It's quite high-dimensional illustration problem. So firstly, we have the domestic shocks, exchange rate, foreign shocks, and the global shocks. For the trade openness, we see that the role of the global shock is rising when the trade openness is becoming high. I think this is quite intuitive, but let me move to the JVC. Okay, so the JVC we define as the sum of the JVC forward and the backward participation. So if the producers are more engaged in production within the value chains, we see that the role of the exchange rate, so the second column, is falling, okay, and the role of the global shock is rising over the intensity of the GVC participation. And the last result I would like to show is the relative specialization in investment-specific goods. Okay, so if we look how the shocks are important as we are looking versus some role of the investment-specific value chains, we see that the global shock is becoming more important when there is a higher specialization of the production of investment goods. This is related also to the literature that the production of the investment goods, like the R&D activity, is concentrated in several hubs, and production of these goods is extremely vertically specialized. Okay, so we have dozens of the robustness checks, and we have also one very quite intuitive result that if we think about the synchronization of export between the countries, the most important are the foreign shocks. Okay, the global shocks are most of them orthogonal, and this is illustrated by the distribution of the cross-country correlation here. Okay, so we see that for the domestic shocks and exchange rate shocks, the correlation is even not significant, okay? But for the foreign shocks, we see that this is extreme, the movement is, pairwise co-movement is very close to 1. So, to conclude, I think that we propose something that is missing, so something that allows to monitor in almost real time the dynamics of the exports. We try to also document that there is some heterogeneity in the role of the shocks. It is related to some general features of the economy, like a trade openness or the integration within the value chains. But even if we think about the value chains, we should go one step deeper. And the one of this result is the specialization in investment goods, which elevates the role of the global shocks and acts as an extreme amplifier of global shocks. Our result also adds to some discussion about the fatal nature of the globalization. Okay, that it amplifies to a large extent the global shocks, and we see that it is mostly driving the co-movement. Thanks.
Thanks a lot, Jakub. And now we have Nadia Cotto from the Bank of Italy, who is going to talk about FDI, the link between FDI and exports of services.
Thank you. Good morning. My name is Nadia Cotto, and I'm going to present a preliminary results of a joint work with also Flavio Ciccioli, Daniele Di Pietro, and Dario Frisardi from the Bank of Italy. What we would like to see if there is some relationship between the multinational enterprise linkages and the trading services. And so let's start. What we know is that services account for a growing share of international trade, not just international trade, but also the value added, but also employment. And from the other end, we also know that a great part of multinational international trade is within the boundary of the multinational enterprises. So, putting together these two facts, we would like to see if firms with multinational group linkages are more likely to trade in services and conditional. So given that we know that firm is trading in services, so do they trade more with more partner countries? And finally, the service trade and group presence overlap geographically. So these are our question, and we try to answer to this question. So we need data. How to construct our database? So we use information coming from our direct reporting system, that is the primary data source for the compilation of the balance of payment, or Italian balance of payment and international investment position. This is a sample survey and focused on non-financial holding companies and insurance corporations. So we have two different questionnaires within this direct reporting framework. One is the TTN questionnaire. So it's a questionnaire where reporting agents are obliged to report as cross-border services transactions. Of course, the value, but also the type of the service, of course, credits and debits. And on the other side, we have this annual questionnaire, this CAF questionnaire, where we obtain information related to the direct investment equity relationship, inward and outward, but also the intragroup financial relationship. So putting together this, so the inward and outward direct investment, and also all the counterpart with financial relationship with the reporting agent, we are able to construct a broader multinational group linkages between the resident firm and the non-resident enterprises, okay? Now, we put together these two datasets and we obtain a microdata dataset with these two kinds of information. So, the service trade information and also the multinational linkage information, okay? Now, these two samples are coming from two different samples, but we here are considering firms that are reporting in both questionnaires, okay? So the intersection of the two samples. So, given we constructed this database, so we can start exploring it. First, we constructed two key indicators. The first one is these serve indicators that is equal to 1 if the reporting agents reported us that there was at least one transaction with foreign countries, counterparts, in the 3 years. And then we have these link indicators that is equal to 1 if for each year the firm has an international link with at least one country, one foreign country. So just putting together these indicators, we can construct this table here on the right. So we can divide our firms in 4 different groups. So the first group is the group of firms that are involved in service trades and are also part of the multinational. The group 2 is related to firms that are service traders, but they are not part of a multinational. The group 3 is firms that are part of multinational, but they are not reporting as services. And then group 4, where we do not have services and also the group linkages. Now, we obtained this database, and we can first explore some extensive margins. So, to understand who trades services. So, what we obtain is that conditional to the group presence, so within the firms with the multinational group linkages, and 84% of these firms trade services. On the other hand, if we just consider all the firms without these group linkages, only the 37% of these firms also trade services, okay? Now, okay, but let's move through an intensive margin, let's say. So conditional, so just considering all the firms that are trading in services with the foreign counterpart. What we can see here is that firms with the group linkages trade much larger values. You can see here in the mean of the value, of course, in the group 1, that is the group with the multinational group linkages and also that are involved in services, they have larger values, but also they trade with more partner countries. And these differences are especially strong for the import side of these services. So, just to see if this result is statistically consistent, we run a regression. We estimate a simple log regression where we have a dummy variable for the. So if the firm is part of the group 1, is equal to 1, otherwise is equal to 2. And we also have some year fixed effects, and we estimate this very simple log regression. What we obtained is that results are robust and also statistically significant because the coefficient, the estimated coefficient are, as I said, statistically significant. And in particular, what we can see from the interpretation of this coefficient is that the enterprises that are part of the group 1 exports services 7 times larger than firms in group 2. And for the import side, as we said before, the difference is also higher because firms in group 1 imports 12 times larger values than firms in group 2. Okay. Now, another step. Okay. Now, if we consider just only the enterprise in group 1, so if we consider enterprises that are in a multinational group and also they are engaged in service trade, what we can see is that the 92% of the firms trade services with at least one country, where there is also a counterpart that is related, is an M&A relationship, let's say, with the firm. And also, if we move to a country perspective, we can say that the 75% of countries hosting a group affiliate are also partner on the service trade. So we are looking to this geographically dimension, and we see that there is an overlap between these two dimensions. To conclude, we answered to our first questions. We have seen that the multinational group linkages are strongly associated with engagement in service trade, but also the trade intensity, and there is some geographically overlap. And this association is particularly strong on the import side. We have a lot of work to do, I mean, because we can explore if there is some service heterogeneity. So we have, of course, as I said at the beginning, the type of service, so we can see if there is a difference between different type of services. But also we can see if the partners are different from different region, countries. And also we can see if there, of course, we know this, that there are some differences in the firm side, because of course we know that there are some difference in their sides, bottom sector, and so on. And finally, starting from this new edition, let's say, of our direct reporting, we introduced a dummy variable asking to our reporting agent to distinguish if the service is traded with or not an intergroup counterpart. So what we would like to see if there is some, to study the results of also this new variable we introduced. So with this, I end my presentation. Questions are very welcome.
So thank you very much, Nadia. And everybody's been incredibly disciplined with the time, so that bodes well for having some time for a discussion. Last but not least, Novita Susanna from the Bank of Indonesia is going to talk to us about trade dependency and FDI for Indonesia.
Thank you. Good morning. Thanks for this. Participant and fellow statisticians. Today I will present findings from our research titled Trade Dependency and Foreign Direct Investment in Fragmented Global Value Chains, Evidence from Indonesia as an Emerging Economy. We are living in an era of economic fragmentation. The globalization that once accelerated our integration into value chain is now being reversed by rising protectionism, resourcing policies, and intensifying geopolitical rivalry between the United States and China. As Southeast Asia's largest economy, Indonesia is caught in the crossfire of this structural transformation. The central question is, how do we reposition ourselves within production networks that are being fundamentally restructured? Our study addressed three critical questions. First, to what extent has Indonesia's trade dependency on specific partner countries shifted over time and has concentrate increased? Second, is the structural alignment between FDI inflow and these evolving trade dependency patterns? Third, are Indonesia's exports increasingly oriented toward downstream, higher value-added final goods, or do they remain concentrated at upstream, intermediate inputs? To address this question, we anchor our analysis to four theoretical frameworks. Our analytical approach drawn on four established frameworks. Comparative advantage. We examine where Indonesia is most efficient within global production network. The Hacker-Allen model, Indonesia's labor abundance and natural resources well positioned it upstream in GVGs, exporting primary commodities and intermediate inputs. Global commodity chain theory, which explains how production is fragmented across countries, with each nation occupying a distinct role. And most importantly, the economic upgrading framework, which maps four pathways: process efficiency, product complexity, functional upgrading toward design and R&D, and change upgrading into more profitable industries. With this framework in mind, let us now turn to what the data shows. Since the COVID-19 pandemic, our data reveal a pronounced structural reorientation in Indonesia's trade dependency. There is clear and accelerating shift toward China's central supply chain, while our relative reliance on traditional advanced economy partners, particularly Japan, South Korea, and Singapore, has declined. One particular notable finding is temporary but sharp surge in export to the United States, which we attribute to strategic front-loading behavior. Exporters anticipating tariff escalation under the evolving U.S. trade policy environment under what we term the Trump 2.0 period. This pattern, deepening China orientation combined with opportunistic U.S. export surge, reflects the strategic complexity Indonesia now navigates. These trade patterns have a direct counterpart in how investment flows have evolved. The structural reconfiguration we observe in trade flow is clearly mirrored in investment pattern, and this alignment is one of central findings of our study. FDI from China has surged dramatically, particularly concentrated in nickel processing, battery production, and smelter development, sector critical to global energy transition. This reflects two interrelated forces: a deliberate risk mitigation strategy by China firm diversifying production into Asian jurisdictions in response to US-China decoupling pressure, and strategic imperative to secure access to Indonesia critical raw material. Meanwhile, traditional investors, notably Japan, has been their relative share decline, reflecting shifting global investment priorities. Beyond who we trade with, it is equally important to examine what we are exporting. Looking at the period from 2010 to 2025, there is evidence of gradual but limited structural transformation in Indonesian export composition by technology intensity. Primary product exports have declined by approximately 10 percentage points, a positive signal. Medium technology manufacturing has grown by 11 points. However, high technology export remains stubbornly stuck at around 5 to 7% of total export. This confirms that while structural change is occurring, the pace remains low, and Indonesia has yet to achieve a decisive technological leap in its export base. Let us now look at the end-use destination of this export. Disaggregating Indonesia export by end use reveals an almost symmetrical split. 4.8% are intermediate goods and 52% are final goods. Intermediate exports are dominated by Asian economies. China leads by 26%, followed by Japan, India, and South Korea. This confirms Indonesia's role as a primary input supplier within Asian production network. Final goods exports are led by the United States at 23%, reflecting robust U.S. consumer demand for Indonesia manufactured products. In short, Indonesia acts as factory for Asia in upstream activity while simultaneously serving as supplier of finished goods to Western customer market. The challenge is to upgrade both roles. Despite our expanding integration into global value chain, a critical challenge remains Indonesia's actual contribution to final value of product in major economy is still modest. Our share in China intermediate supply chain and our contribution to U.S. final consumption both remain in range approximately 1.2 to 1.8%. This confirms that Indonesia continues to occupy predominantly upstream position, providing foundational raw material inputs rather than participating in higher value-added design, engineering, branding, and knowledge-intensive stage of global production. Increasing this value-added contribution is perhaps a single most important structural challenge facing Indonesia industrial policy in the coming decade. Drawing this trend together, let me now present our key conclusion. Our finding coverage on three interconnected conclusions. First, shifting trade dependency. Indonesia trade dependency has become significantly concentrated toward China during both the post-COVID and Trump 2.0 period, while declining for traditional partners. This generates both strategic opportunities, particularly in accessing China capital and technology, and high-end vulnerability to bilateral tension as systemic shock. Second, aligned FDI pattern. FDI flows structurally mirror this trade dependency shift. China and the US have increased investment while Japan's share has declined. Geopolitical tensions are actively reinforcing to relocated of investment to Asia. Indonesia is a principal beneficiary but also increasingly exposed. Third, persistent upstream position. Despite policy effort to promote industrialization, nearly half of Indonesian export remain intermediate input from primary to resource-based sector. Industrial downstreaming moving from raw material export to proceed and value-added products is no longer an option, it is a strategic necessity. For us as a statistician and policymakers, this structural change carry direct implications for how we produce and interpret external sector data. We need granular, partnership-specific data. Aggregate data can give a false sense of security. The risks are in detail. We must strengthen value-added indicator. Conventional growth trade statistics are insufficient to capture GDP depth. Trade in value-added measures and input-output framework are essential. We must integrate trade and financial statistics. Traditional framework treats this separately, but cross-border production networks increasingly link trade flow with investment decisions in ways that demand integrated analytical lens. And we need to move statistical authorities beyond data compilation toward genuine analytical function, including very early warning indicator for trade dependency, market exposure, and supply chain vulnerability. Ultimately, institutional strengthening and cross-agency collaboration between central banks, National Statistics Office, and relevant ministries is not optional. It is precondition to producing statistics that are relevant, timely, genuinely policy-oriented. With that, let me close with a brief summary. Thank you for your attention. I hope our finding contribution meaningfully to today's discussion on strengthening the analytical foundation of external sector statistics in emerging economies.
So thank you very much, Novita. And we have actually half an hour for the Q&A session. Maybe I could just kick-start it by asking one question to each of you, and then we'll move on to the questions from the floor. So first on Lawrence, do you think there is a link between the extent of reporting that FDI markets capturing and geopolitical tensions themselves? So if there is increasing anti-China sentiment in some Western countries, is it more likely that investment going through intermediate routes may not be advertised or highlighted as much in the press, particularly in Chinese press, and that may exacerbate the evidence on a decline of linkages with the West?
Well, thank you for this very interesting question. And I think it's clearly a possibility, yes, that, as you say, sentiment that tilts toward against geopolitical foes might discourage reporting. And given that the database relies on public information, this is indeed a possibility that this could exacerbate the results, because it clearly might correlate with the geopolitical alignment indicators that we have. But that's what's in the data, and there's no clear way of stripping that out. So, but it's a good caveat to keep in mind. Yes.
Let me ask Jakob whether there is any way you can break down the impact of global shocks between the impact of global shocks between those originating from China versus the US. How would you think about it?
We haven't. Thanks for this question. So it was not our perspective to also map to some geographical dimension. The key problem is that we have with the VIA, technically, with the VIA we need a long data series. Okay, and we know that we have 2-3 events. Probably it's feasible. We have some measure for this. In a robustness checks, when we have a trade policy uncertainty, we can make some IV and so on to get some result. But this is the short-run variation. I think we should distinguish between them. Okay, so in the short-run variation, there could be, for the trade flows, the result could be different, because we know that if there is some tension on some part of the economy, there could be also some winners of that. So I think it could be not so straightforward to observe, like when you explore the long-run variation, when you look across the firms. But in general, any measures of uncertainty that we exploited, they are providing rather contraction of export. So my baseline guess is it will be negative, but the question is the magnitude, how it is important.
Thank you. Nadia, it was not completely clear to me whether you're using the dimension of transactions as well, or the existence of trade. So if you're not exploiting the quantity dimension as opposed to existence of a trade relation, I wonder what the evidence is on that front, on the size of the transactions, in addition to the existence of a linkage.
Actually, we explored both, not just the presence, but also the value, the amount. And also, if you remember in the regression part, we saw the effect on the amounts, okay, not just on the presence or not of the service trade, let's say.
And conditional on there being a relationship.
Exactly.
How can you compare the two magnitudes? So the existence versus the probability of there being a relationship versus the intensity, so extensive and intensive margin.
We have this information in our dataset because, of course, we do not just have. We also have the amount of the services that are imported or exported, let's say, the credit or the debit side. So we have both the information in our dataset.
And how do they roughly compare?
They are much larger, conditional. I mean, if they are part of the multinational group, they trade much more than if they are not part of the multinational group. So, yeah, in this sense, it's...
Is your sense that that is a firm size effect? Or
it
is
could
it...
be. I mean, it was just a descriptive, let's say, analysis. It could be because also in the following work, what we would like to see if there is some size effect of the enterprise in this kind of patterns or not. Yes, it could be. Yeah.
Thank you. Novita, last. So I thought the evidence was absolutely fascinating. I was thinking whether you could cast the same type of pictures in a way that adjusts for the global role of different countries. That is, are you observing that dependence on China is increasing more than proportionately to the importance of China in the global market? Or vice versa, Japan, there's a decline, but of course the share of Japan in global GDP and in global exports is declining. So are you able to distinguish in case between the two? And just to, I mention this because if you think in orders of magnitude, China adds at least one Indonesia a year to its GDP, because if you think of 5% growth rate, 6%, perhaps nominally 5-6% on a $20+ trillion, that's north of 1 trillion. It is roughly in the ballpark of Indonesia's GDP. So comparing the absolute share in consumption or trade of China and Indonesia is not necessarily reflective of what Indonesia's prospects are.
Thank you for the question. In this research, we focus on China and the US because there are our most largest market of our export. So we are not yet looking for a specific country yet because we are going to research about this. Sorry, I appreciate you raising it, but it's someone I would like to examine more carefully. And could we continue this conversation outside the session? Thank you.
And let me open the floor for questions. I doubt I'm able to see hands. I see Carlos because the first row. But if there are hands in the back, please find some way of communicating because I feel like a deer in headlights here. Carlos. Oh, sorry. We have plenty here. Oh, there is a roving mic? Well, oh, you have.
Oh, thank you. Thank you very much. So, Carlos Sánchez Muñoz from the IMF. So I have a question for Novita. I think you know your findings about China are not surprising. That China is to some extent reshoring to Asian countries is something that sounds natural to me. What was a little more surprising is the decrease in the exposure of Japan, both for FDI and trade. Do you have any explanation about why this might be happening? And then if I'm allowed, I would ask a second question to all panelists. So we economists usually look at the past and try to explain what has happened in the past. But it could be also interesting to look at what might happen in the future. I know that we live in an unpredictable world and now more than ever, but nevertheless, do you have any intuition about what could be the results of your research if you were conducting the same research, you know, in a few years' time or in a few months' time?
Maybe we can collect a couple more questions. There was one in the back.
Okay, good morning. Thank you all for your presentations. My name is Adam Skrenta and I work for Current and Capital Account Division at Narodowy Bank Polski. And my question would be to Ms. Akoto. Your presentation was of particular interest for me. And your key insights. And I would like to have just one methodological question, if you could make a comment on why you decided to exclude transport services from your research. Thank you very much.
Hello, good morning. My name is Jorge Dias, European Central Bank. Thank you for the presentations, and I have a question for Lawrence. I really like very much the framework that you have here. And picking up on Philip's Lane point, whether this framework can be expanded to analyze also the tariff shocks, and whether you thought about it. And if I may, a second question to Jakob. I would like to hear from you a reflection on why you selected the nominal exchange rate and not effective exchange rates.
Maybe we can... there was one more question in the back. Thank you.
Thank you very much. My name is Kamila Kusiewska-Pawlak, Narodowy Bank Polski. And I have two questions. Lawrence Enter. The first, I wonder whether the data on foreign direct investment that you use from Financial Times, are they cleaned from the SPE, Special Purpose Entities, foreign direct investment? And second, thinking about the concentration proximity trade-off, I was wondering whether in your FDI equation, do you have the exports included on the right-hand side of the equation? Thank you very much.
Okay, let's start with these, and maybe we can go in reverse order. Novita, you want to start?
Thank you for your question. I believe this research is already based on our data and trade data and FDI data. So I think the decline is Japan investment. In Indonesia, is driven by a combination of domestic policy, and intense regional competition, and Japan's own economic challenge, I think. Thank you, that's it.
Okay, so starting from the question on the transport services, you are right, I didn't say it, but the travel and transport services are outside our TTN framework because we have two different surveys that we use in order to compile these two items. That's why we excluded it from our analysis, because we do not have microdata on this type of service. And if we see in our work in the future, I mean, I think that, of course, in the future, given that the digitally deliverable and also the knowledge shifting of services, so I'm quite sure that everything is going to increase, also this kind of relationship, but we will see. Okay.
Jakub?
Thanks about this question about exchange rates. I think it's a better choice to have the nominal. There are several, I think, arguments. Firstly, if you identify shock, it's mostly based on a variation in exchange rates. Okay, secondly is what type of the real exchange rate we should use. I really don't know. If we think about the export and the relative prices, if we should somehow account for the prices of the export versus some import from different destination, it's more complicated. It's not the general picture, okay? But the last point is we have to some extent the prices, so within the VIA model, there is some, let's say, in endogenous manner accounted real effective exchange rates. Yeah, so we make a different. We also control for major currencies and so on. So I think it's better to use the nominal effective exchange rate.
Okay, so thanks a lot for these very interesting questions, also from my side. Maybe I start in reverse order and then I finish with the most difficult one about looking into the future. So about whether we have included exports also on the right-hand side. At the moment, we did not. It's a good suggestion, and we can check what happens if we do. But one thing we do include on the right-hand side is things that also drive bilateral exports. For example, in some specifications, we have bilateral fixed effects that capture everything that's not varying over time. But in other specifications with the IPD measure, we have things like that are also vary over time, for example, free trade agreements between the two country pairs. Then regarding your questions on whether the data are clean from SPEs, I think technically you've seen this evidence on the role of financial centers in the data compared to the official data, that they play much less of a role in these Financial Times FDI markets data. But the funds that are channeled through SPVs to finance these projects that are recorded then at the end in the data, they might still be there somehow, right? Because they just have the announced and sometimes estimated value of these projects. So somehow in the bilateral pattern is somehow obfuscated in the official statistics by the role of the financial centers, and that's less of a problem in these data actually. So the question about can this be applied to tariff shocks, it's actually very good because it gives me the opportunity to promote a recent bulletin article that has just been published in the ECB Economic Bulletin, where we do exactly that. So also with colleagues, we investigate whether the bilateral FDI flows react to tariff announcements, to tariff imposition, and one of the findings is there that there seems to be actually some evidence for tariff jumping. So if the tariffing country increases the tariffs in a broad sense, so meaning on many products, FDI into that country goes up. But the key thing that we find is that for manufacturing, which is highly global value chain intensive, it actually goes down, the FDI, because then the destination country becomes less attractive. Then finishing with the perhaps most difficult question of how can we bring this to the future, what we think about what our results imply for the future. So one thing we did for this conference is basically update our results, and what we would have liked to see is this trend towards geopolitical fragmentation in bilateral greenfield FDI to become less important. That has not materialized because it actually became more important compared to the results that we had previously. Looking at the state of global politics, I'm afraid that that might continue. In that sense, I can, again, only shamelessly advertise work of colleagues at the ECB who have looked into scenarios of what further fragmentation along geopolitical lines might imply for the euro area growth prospects and inflation developments. And you can find them also in the ECB bulletin. And they were part of what motivated our research into this. And just to summarize that the euro area would be particularly badly affected by this, given its substantial reliance on global value chains.
Okay, I wonder whether there are further questions from the floor. Otherwise, I can add one. Yes, please. Second row.
You discussed that euro area FDI is moving towards more geopolitically aligned destinations. But you gave an important exception, specifically Hungary. And I would like to ask you whether you think if that investment is about economic integration or about bypassing euro area or Europe trade barriers. Thank you.
Good point. Let me check whether there are any more questions in... Oh, this works. No, then
I go ahead. Yes, so as I mentioned in the presentation, one thing is about euro area investment going out and into the euro area, which is more closely aligned countries. But then there's this exception of Chinese investment into Hungary, which, as we said, and these are our views, right? Look to be aimed at building domestic production capacity in the EU to be able to circumvent potential tariffs, because they are in electric battery production, they are in electric vehicle production. That's exactly where then afterwards, after these investments took place, actually you saw tariff increases. No?
Thank you very much. Maybe let me add a follow-up on what Carlos asked and see if anybody takes the bait. So in terms of looking forward, for research design, for the type of topic you're addressing, we are seeing here the confluence of two aspects of geopolitical fragmentation. We see an increase in geopolitical tensions and more fragmentation across broad geopolitical blocks. But we see another one over the past year and a half, which is fragmentation within the West, broadly defined, one of the political blocks. And so in terms of research design for the types of questions your papers are addressing, of course, we don't have enough data to do a lot of empirical work given the recent nature of the shock, but how would you think you could take these developments into account in research design for the topics you're addressing. Thank you. And you should feel free not to take it, but just trying to be a bit more provocative. Thank you.
So maybe starts. I think we always should ask the question whether, because as economists we ask what something is going on a financial market, global economy, something extraordinary. What is it? Shock with transitory effect or the long-run change, structural change? And this is the question about the research design, whether what we observed with the tariff wars and so on, whether this is something transitory or not. Okay, so whether it reshaped the fragmentation or not. And this is the question which is next to research design in all our cases. Okay, so we can use this, but I think if this is the long-run change, then naturally we have to cross-check whether our research design is robust to this. Probably, going back to what I presented, we provide something at the macroeconomic level. Well, of course, the fragmentation is used in a second step when we want to explore the cross-country heterogeneity, so probably the tension will reboot the structure of the value chains and maybe some result will be changed, but I think that the role of the global shocks will be still dominant.
Thank you, Jakub. And anybody else?
Yeah,
removing your institutional hats.
Yes, which is tricky, you know. I think it's a very good question, and particularly because it's very difficult to answer, right? I think colleagues have tried to get more dynamic estimates of these kind of block affiliations. So relying more on those could be one option. And then I think moving to specific issues like tariffs, right, and separating them perhaps from other geoeconomic alignment which evolve around military alliances, which, you know, as much as they seem under distress, they seem to hold up for now, could also be an important consideration.
So it's a very difficult question, but me as a compiler, as a statistician, what I can say is that what I can promise you is that we will study and see if there are, as I said, the conclusions. What we will see if there are some geographical patterns to explore. So this is just what I can promise you, not more.
Thank you for raising that. It is something I believe deserves future attention, and I will be happy to explore in the future work with my colleague.
Well, thank you very much, and warm thanks to the speakers for being as disciplined as I've ever seen on a panel, finishing 5 minutes early. It's, I think, a world record. So thank you very much. Please join me in thanking them appropriately. And and as I understand it, there is now a coffee break. Thank you.
Ladies and gentlemen, our second session on the FDI, multinational and geoeconomic shifts will be chaired by Mr. Piotr Żuk. Piotr is Deputy Head of the Economic Analysis Department at the Narodowy Bank Polski. So, Piotr, the floor is yours.
So, good morning, everyone. So it's my pleasure to chair this session, but I will feel more comfortable also with the speakers on the stage. So please join me here on the stage. Yes. So the topic of this session is FDI, multinationals, and geoeconomic shifts. We have 4 presentations in this session, but 5 participants. The one presentation will be presented jointly. And we have 1.5 hours scheduled for this session in the agenda, which means that we have around 15 up to 18 minutes for a presentation. After all presentation, we'll have some time for the Q&A session. So I hope that you will actively participate as well in the session. Okay, let's start with the presentation. The first presentation is by Renan Abrantes de Souza, who is Deputy Head of the Balance of Payments Division at the Central Bank of Brazil. Renan will be speaking about fragmentation and friendshoring in global FDI, a network perspective. Renan, please, the floor is yours.
The control of the presentation slides. Do you know where is the... it's this one. Okay, thank you. Hello everyone, good morning to you all. It's a pleasure to be presenting to you. I am Renan from the Central Bank of Brazil, and I'm going to present fragmentation, friendshoring, global FDI, network perspective. So first, the motivation for this study. We all understand that geoeconomic fragmentation, friendshoring are reshaping the debate on global economic integration, and direct investment is one of the pillars of this integration. The literature about it is still incipient, and both fragmentation and friendshoring remain elusive concepts. So we're trying here to create new measures, to create a benchmark, to measure and track them. Our conceptual proposal lies in 3 interconnected layers, and we are going to study here the first 2, the microstructure, the bilateral ties that are embedded in this network of global FDI, and the mesostructure, the local clustering, how countries cluster within each other in regional and other FDI friendships. So in this study, we focus on the first 2 layers. What we are trying to answer here, what are the main questions? What can an FDI network perspective reveal? Who matters most in a country's inward and outward FDI allocation structure? How concentrated are a country's inward and outward FDI positions? In the global FDI network in this system, who is friends with whom, after accounting for both bilateral and aggregate weights? How intense are these FDI friendships? How do FDI friendships cluster across country groups? That would be the mesostructure. And if 2 countries have similar FDI friends, are they also close to each other? So that will be a motto of birds of a feather flock together, homophily in here, okay? And how are FDI friendships related to geopolitical alignments? Lots of questions, but not that much answers, okay? Let's go to methods. I'm going to present very quickly. So we used here bilateral FDI position data using the CDIS positions. We have a question about using flows versus positions, and we chose positions because it has more stability and long-term trends. So to track friendshoring and fragmentation, we thought it was better, okay? We used total stocks, equity plus debt. We ruled out non-negative values, which is a kind of a statistical treatment. And we also had to smooth data series using 3-year average on the CDIS data. We used 2012 to 2024 data of the CDIS. And we created some measures to track what we tried to do. The first one would be allocation share measures. So from the recipient inside inward share, we took the share of investor with country J in the total inward FDI position of country I. In the other side, the investor side outward share would be the share of recipient I in investors J's outward FDI. And using this data, we calculated a concentration measure using Herfindahl-Hirschman index. Next, we calculated reviewed bilateral importance measures. This is a kind of salience measure in network. We were inspired by reviewed comparative advantage concept of Balassa. And we tried to compare using the importance of the investor of the recipient country in the world. So it's a kind of normalization here in both economic terms and network terms. And using this data, we also calculated reciprocal reviewed bilateral importance, kind of tricky. But in here, we are trying to create a network in which we have from both sides really importance from, let's say, one country to another. If one country is a very big investor, disproportionate investor in another, and vice versa, we will remain that in the network, okay? This is a binary measure. Okay, and one thing else about the methods is the triadic proximity. This is to trying to see what are the network terms in a way that we can measure if a country is close to another, looking at his friends. So if you participate in many similar triangles in this network, you will be probably a friend of that country as well. Let's take Argentina and Brazil. I don't know if you can see in there, but they are basically friends with the most similar countries in there from Latin America, South America. So they are both friends to Bolivia, Chile. And you can see right there that the proximity would be 0.56. And there is also another example that you see in the triangles about Nigeria and Tanzania, that their proximity is also very high. If you want to discuss with me further, I will be happy to do it next, okay? So let's go to the results right now. I'm in a hurry to present. And the first one is to see a snapshot in 2019 of dependence on the United States. So on your left, you have the top 20 recipient countries for which the United States is most important as an investor, the allocation share. And on your right, you have the top 20 investor countries for which the United States is most important as a destination. And you see some expected figures in here, like Canada, which is dependent on both sides. Costa Rica is kind of dependent as well, Mexico. But it's not like a symmetrical relationship. You have some countries that are more dependent on one side than another. So here, kind of tricky graph, but here is the concentration measure from the recipient side in the x-axis and from the investor side on the y-axis. And you can see that we have some countries that are more dependent. It's allocation shares as a total, they are more dependent. You can see, as I said, Costa Rica, they have kind of medium concentration share, but we have Ukraine with a very high from the investor side. We have Oman with a very high from the recipient side, and so on. I don't know if you could find your own country, but I can show you afterwards. Let's go. So after that, we have to talk about these salience pairs, these most important FDI friendships for you to know what would be the intuition behind it. So it's kind of interesting to have in here some regional pairs. The Baltic countries, they are very friends in this relationship of FDI. You can also see some financial hubs working through some pairs. You can see Curaçao. You can see some Latin American countries in here and some colonial relationships as well. So these are the top 20 directed pairs by recipient side salience on the left and investor side salience in the right, okay? We took that reciprocal links in both sides and we built this network, which we call the FDI space, is a country network, and we can see how they cluster. So in your upper right, you can see the Latin American cluster. And what is funny here, what is interesting as well, is that they have Spain and Portugal, so we have some colonial ties. We have the European clusters in the bottom and in the center of the network. If you are trying to find Poland, they are in the very bottom of the image, probably behind one of our colleagues in there. And it's tied to Hungary, to Croatia, Slovenia, I think, and some other countries. In your left, you have the Asian cluster, and in the center, you have the African and Middle Eastern cluster. I cannot tell about everything in this network, so let's go. So we used all this information to make some econometric identification, and we ran panel regressions in which we tried to associate contemporaneous FDI friendship with geopolitical distance, so a kind of fragmentation, having controls of geographic distance, common language, the ideal point distance that Lawrence also used for geopolitical distance, and that measure of triadic proximity that we calculated using this FDI space. So these are the results. I am not going further and deeper in the econometric results, but one thing that is very interesting is that geopolitical distance has a negative effect on this FDI friendship, and the triadic proximity has a positive effect. Once again, this is contemporaneous association, is not causal effect still, okay? And let's go to concluding remarks. So this is still work in progress. This is the very beginning of a study. We observed that it's very hard to have benchmark, to have new measures to track what is really FDI friendship. So then we can study fragmentation. So the main contribution of this study is the very new definition of what would be these measures to monitor and track bilateral and group level FDI relationships. We have allocation shares, we have concentration shares, reviewed bilateral importance, the FDI space, and triadic proximity. Potential future research that we can open avenues in here would be to study the evolution of the FDI space over time, to study the long-term effects of increasing geopolitical distance and decreasing triadic proximity, and to study co-movement between FDI and international trade, and study the effect of exogenous shocks such as tariff hikes, the US hike, for instance. And connecting with the guys of the last panel, I think it would be nice, for instance, to use those communities of the FDI space to recalculate the between and within effects of Lawrence's study. I didn't find it. And for Novitas as well, to, I don't know, to see what, if these results, they connect with something that Novitas presented. I think there is a lot of work to do next. And that's it, guys. Thank you. Thank you very much.
Thank you, Renan, for your very interesting presentation and research on this very topical issue of geoeconomic fragmentation and friendshoring. And indeed, actually, we, as a Central Bank of Poland, very often receive questions from investors, rating agencies, and other stakeholders who are interested in friendshoring, whether we see signs of this in the Polish economy, and we always have a hard time to answer this question because it's really hard to define what the friendshoring is. So thank you for pointing this out as well in your presentation. And now we'll move to the second presentation by Perla Ibarluquea Flores, who is statistician at the OECD, working already for many years on FDI and sovereign debt statistics. The title of Perla's presentations will be Fragmentation in Global FDI, Evidence from a Novel Methodology to Estimate Ultimate Bilateral Exposure. Perla, please, the floor is yours.
Well, sorry. Good morning to all participants to the External Statistics Conference and to the organizing committee for the opportunity to present our work on fragmentation in global capital flows, together with Etienne Lepers from the OECD. Well, sorry. Okay. Here. Well, as with the data contribution, there is, of course, existing work to estimate ultimate FDI. We have already know the well-known and outstanding work from Casella that proposed Markov change model, or Denmark, who also estimate UIC based on Orbis and using SPS data, or Turban from OECD, who make a global matrix estimation only for 2016, and recently Haverly, who made estimates for offshore for 2015. Well, all these diverse empirical research, it's very important, but each of them presents certain limits in each approach. And there is no estimates on ultimate FDI post-2018. However, we observe that there are improvements in direct UIC reporting, because there are 18 OECD countries who report involuntary basis UIC country. So this is a very good sign on the health of statistics. So the objective of this working paper is to build a novel and comprehensive global data set, no data gaps, across 231 bilateral pairs, for the immediate investment positions since 25 to 2024, and by UIC investment positions over 2013 to 2024, sorry. We propose some important methodological improvements, like we are going to use the reported UIC data. We are going to use of this very well UIC by counterpart. We are not rely on SPEs or Orbis to estimate pass-through. And we propose a matrix balancing approach to get a more smooth inward or outward total FDI across the whole period. We also try to deal with some reported unallocated, as you know. Sometimes the countries have unallocated amounts. They're usually not so large, but still could put a little pollution on the data. And at the end, we built on that and refined the methodology established in previous works to estimate OIC. On the empirical issues, we already observed that international financial centers, including what we call OECD ICFS, which is Ireland, Luxembourg, Netherlands, represent about 50% of the global FDI and portfolio positions. But this probably, it's pass-through that needs to be worked out. First, we construct a balanced matrix, bilateral matrix, by immediate investor. This is the matrix in a simplified way, just to show you that we consider OECD countries, all 38 OECD countries, using the data that they report. For other countries, the IMF CDIS reporting countries for positions. And for the rest, sometimes there is no reporting, but we use to complete and fill the data gaps using historical national data. And for early periods, we make a very detailed analysis on the bilateral relationships and construct the time series to try to make accurate interpolations or two-year backcasting depending on the type of problem that we observe. And few countries, we assign mirror data. For the rest of the world, like for most of the African countries, we use gravity estimates for that end. With the matrix balanced algorithm, as I mentioned, we deal with reported unallocated and to try to smooth those observed asymmetries between the inward and the outward part for the positions. The key part on our algorithm is to use the rebalancing, but with weighted for each bilateral relationship based on the data quality. So that means that for us it's really important when the country reports the data, we assign the highest value. That means that the algorithm will not change the value, but it will help us to redistribute the unallocated amounts in a smoother way, so we can use it for the next step of our procedure. We then make some checks. We optimize those trends that probably are not aligned with what's recorded historically. But once that we check the internal consistency of the matrix, we go to constructing the global FDI matrix by FDI ultimate investors. As we mentioned, there is this existing outstanding work by Ultimate FDI, but here we use to fill this bilateral matrix for all this year, the OIC that it's already reported for those countries, for these 18 countries. But then we follow and try to improve the methodology in previous OECD works, notably Turban, who made the global estimate for the matrix in 2016, with some changes that we inserted, as also to test the time varying effect when we calculate Markov change probabilities across different years. So our methodology is very simple. We follow just 4 steps. First, we compute in this methodology the pass-through for each investing country as the ratio between the sum of all reported OIC position and the sum of the IMC for the same countries. Once that we have these ratios, we use the result of our balanced matrix and use the pass-through and the non-pass-through probabilities in absorbing Markov change procedure. So being the probability that partner investing be the ultimate investor country in certain destination. Then the third will be effectively to find and calculate the FDI by UIC. We make checks through this period, 2013-24, and we find that the estimate that we obtain through this methodology versus the historical data, it's around 94% of correlation. So we got pretty close values. Also, as we were discussing, we have this problem of the pass-through. So at the end, we eliminate the double counting by deducting to all positions the share of pass-through that we calculated through this methodology. This is just to show you, in general, the global FDI captured in different approaches. We have in the blue one that it's below, it's the UIC ones that we deducted the pass-through and the round-tripping, also estimated. And the tiny difference that will be between the IMC total global FDI versus the IMC that we obtain through the balanced procedure. Of course, the balanced procedure may look a little bit higher because of the allocation that we made, but we preserve the same trends. Derived, we obtain a calculation of global pass-through about 40%. We did an exploration of recent changes in the global FDI network. So you can see immediately, for example, it's straightforward that for one of the top ultimate FDI investors in the United States, for example, Netherlands, it drops from between 12–14% to below 6%. So this is a change. So the story that we say, or the findings based solely on AMC, may quite different from depending which approach we use. If we saw, for example, the share of Chinese investment, it's also straightforward when we saw Hong Kong. The IMC share, it's almost 60% because it contains pass-through round-tripping. And then when we make the calculations together by the UIC, we saw that the Hong Kong is less than 20%. We saw also we make another kind of statistical overview to see if there are recent changes in the global FDI network. So we can capture, when we do some recomposition on the change in share of regions, we took, of course, for this story of the fragmentation, certain key geopolitical blocks. In this part, we only present the connectors linked to the trade story. But we can observe from the destination perspective, that means all the difference in share accounted by the different investing regions as a percentage of the total inward through China, it not changed too much. But when we saw, for example, the EU that goes through different blocks, we can saw that there are some higher shares. So that means that, yeah, the ultimate investor has a relevance to the bill and to see this difference between the regions. Also very important because with the UIC, we can see in a more clear way the ultimate exposures from the international financial centers. If we observe the immediate exposures, we can see a slightly decline from 2017 to 2022, probably linked to the tax US reform in 2017. But it's not very clear when we saw the immediate statistics. But when we saw the positions on ultimate basis, we can see clearly how they shrinked and see that declining trend due to this tax reform. Just to confirm that what we were finding it makes sense with the recent fragmentation analysis, we also perform a gravity model for fragmentation analysis. It's very similar, and thanks to the presentation of the first presentation of this morning from ECB, where I think our work and your work, it's a good complement, because we test similar dummies and financial linkages between these relevant geopolitical blocks. And we also test an additional dummy to see if any counterpart is part of non-aligned block in these 3 block definitions. And then the rest, it's the same as we used to deal in the literature of gravity. Our finding is, for us, it's quite relevant because we saw a strong role of geopolitical groups in driving bilateral FDI exposures on an immediate and ultimate basis. We saw that the coefficients are pretty aligned, with the exception of the US allies bloc. But when we saw the same regression, but since 2022, to see if after the war in Ukraine onset has made a more importance, increasing the role of the geopolitical blocs, it's not very clear the evidence, but still we found some evidence of even, we interpreted as less investment between blocks since 2022 on a UIC basis. And this, with this good research on Gonipat in 2025, that they found certain evidence by ultimate exposures. Well, now, finally, our conclusion is that there is still a lot of work that we need to do with all these fascinating data that countries produce and the data that it's available there. We propose to use in a more cleaner way, use the balanced matrix model together with the Markov absorbing change procedure, and use also the official available ultimate investing countries. The benefit for future use is that as more countries are expected to report UIC, this methodology can improve in the coming years. There is also the empirical application that we could revisiting the role of geopolitical blocs and some other extensions overall on the importance of offshores, the regional and country level shifts in partners, productivity in multinational activity, and of course on tax avoidance and the impact of tariffs on FDI. Thank you very much for your attention.
Thank you, Perla, for your insightful presentation on a highly relevant topic. And indeed, I think that tracking FDI down to the ultimate investor is very important for understanding the true scale of the geoeconomic fragmentation. Now we'll move to the third presentation by Manfred Viquez Alcazar, who is head of the International Account Statistics area at the Central Bank of Costa Rica. But Manfred, he's also a professor of economics at the Universidad Latina of Costa Rica. Please, the floor is yours.
Well, thank you to Irving Fisher Committee, BIS, European Central Bank, for the opportunity to share to you some of the findings. Let me say that I co-developed this paper with one of my students during his internship at the Central Bank. So I want to thank him, Julian, for his contribution to this. Okay, first, motivation. I do work at the central bank, so I want to expose some vulnerabilities using simple analysis within the balance of payments aggregates. First, to understand what is the rising concern is the geoeconomic fragmentation may produce some vulnerabilities that are not always evident within the balance of payments aggregate. But if you use a multidimensional analysis, taking into account balance of payments aggregates and microdata linking, this macro data linking will allow us to expose some vulnerabilities, which are very relevant for the authorities at the central bank to expose that there are more than one channel of transmission of balance of payment shocks. Costa Rica is a very small but very open economy. So since the 1990s, we tried to implement a strategy of development based on the attraction of FDI. And after the end of the 1990s, with the arrival of a semiconductor enterprise within the country, we have been focused on two important manufacturing activities, which are medical devices and semiconductors. And, well, the idea of this paper is to use both FDI aggregates and macro data linking. So what we're doing here is try to examine through multiple points of view, FDI, trade, TIVA aggregates, microdata linking, firm analysis, to expose that there are a huge vulnerability on what it's been seen in my country as a successful development model, but underlying a very strong vulnerability, and what this exposure has to be taken into account by authorities, especially at the central bank. Data coverage, we're using data from trade and FDI since 2002, 2025. And, well, TIVA results are not as often, and some services by destination are as well not available through all those periods, but we use the multi-dimension analysis to understand what is happening here. And first, FDI as an anchor of specialization. There is a very thin line between specialization, concentration, and the vulnerabilities this poses. So FDI drives export specialization in high productivity sectors. As I told you, medical devices, semiconductors, and some IT services. There's a very strong presence of multinational enterprises, and there's a strong link between FDI and trade integration within the GVCs. So this leads us to a high dependence on reinvested earnings and intra-firm company flows, and FDI concentration increases the exposure at the firm level shock. We'll see there's also very high concentrated firm situations, and in which cases this implies or poses a threat to the economic stability. So first, as you can see, we're arriving to the same conclusions as our colleague from Brazil regarding our dependence on FDI coming from one single country. And if you see, if we add up the second and third countries, the story doesn't change much, because the dominance of the US economy in our case is very high. So we have a very high concentration on FDI attraction. But on the other side, we notice we have two, let's say, two Costa Ricas. One is within the special regime, which have a special tax treatment, and the rest of economy. And you see more and more special regiments are the focus of the FDI attraction, and they are also very concentrated in few economic activities. Then we have the concentration of the external trade, which was driven by the same circumstances I already told you about the FDI flows. Export concentrated on few products, and on the manufacturing side, you have medical devices and semiconductors. Things on the services side tend to be more diversified, so we have a little compensation on services, because tourism or IT delivery services are much more stronger. We have a surplus in services, and we are very, very close to have a surplus on goods, which was extraordinary for an economy like Costa Rica, but I will tell you what vulnerability that imposes. Goods and services have different kind of behavior. Exposure varies across different trading partners, and limited diversification raises resilience concern. We have been told like that we are a very happy country, so things usually seem to run smoothly and good in my country. But underlying this, there's a vulnerability threat that poses to us regarding the behavior or firm decisions. So limited diversification, limited the kind of resilience that we have. And we see that this is more a structural situation than a particular situation. If we see here, again, as well as the FDI is concentrated in the special regimen, exports seems to be getting higher from that regimen. And they are always direct to US. So we have concentration on the origin of the FDI, on some economic activities, on some regimens, on some firms, on some market destinations, which in all cases leads to the same place, to US. If you see, medical devices now account for more than 60% of our total exports within the special regimen, and close to 50% of all the total exports of goods. Export concentration at firm level is also very important. We use the Herfindahl index also, Herfindahl-Hirsch-Schleifer index. And we find out that there's export dominated by a small amount of enterprises. Firm level concentration is also mirror exposure of the FDI and the trade concentration. So there's a systematic relevance of those 10 firms that account for more than 40% of total exports. So most of the exports are concentrated within 10 firms, and all those 10 firms are within a special regimen, and they are all multinational enterprises. They are all coming from the US. So you see the amount of exposure that we have to those kind of situation of concentrations. And if you take into account the participation of Costa Rica within the value chain, we quickly realize the OECD TIVA results show us that we have high import content embedded in our exports. And we have, very low forward linkages. The spillovers with the rest of the economy are very limited. So the implication for resilience and policy making are very, very strong in this case. The domestic value added is concentrated on some specific activities, firms, and sectors. Regarding the M&Es and BOP channels, the purpose of the paper is exactly to expose what are the multiple channels of transmission in the case of a shock throughout the balance of payments. So in the case of multinational, it affects trade as well as income, as well as flows, financial flows. And we notice through the time, reinvested earnings gain a huge chunk of total FDI. So again, more vulnerability because we depend on intra-firm decisions to see how much exposure do we have to some kind of fragmentation or any shock decided by some specific companies. There are strong linkages between the trade and the income account through the income of FDI. So this is a good time that we have BPM7 to improve our analysis regarding the external exposure and to see what's the role of those enterprises and firms within the GVCs. And it has the treatment of intellectual property that we have to work a little bit more, as well as ultimate investor, to try to improve our analysis. Finally, what we see here is the reinvested earnings now account for 2/3 of total FDI. So I want to tell you for one quick example. The largest semiconductor enterprise recently decided to move manufacturing from Costa Rica to Southeast Asia and leave all the services within Costa Rica, but not the manufacturing process. So it has a huge impact on our balance of payments. Thankfully, it reduces the total export, but also reduces the income debit. So it didn't pose much a distortion within the current account. But it also decreases the reinvested earnings that we have in the financial account. So I was trying to present this to our governor, and I asked him, do you feel comfortable me talking about vulnerabilities of what for the rest of the people seems to be a very successful model of development? And he says, well, I agree that somebody has to tell the difficult truths and not likely words. So I count on you to do it. So basically, this is what we found. The analysis showed the external concentration about trading partners, sectors, firms. Is that a sign of a wrong policy? No. Is a wrong strategy? No. But it shows there is a vulnerability to take into account through multiple channels through the balance of payments. So authorities, especially the central bank, must be aware of this. And external shocks can propagate through all those different channels: trade, FDI, participation in global value chains. And we have some research to do regarding this, because my governor says, well, next step for you is to present to me some stress testing based on your findings. So we have just more work to do, but that's fine. Okay.
So thank you, Manfred, for your extremely interesting presentation about the experience of Costa Rica, and thank you for telling us the difficult truth about vulnerabilities. Now it's time to move to the fourth presentation of our second session, and this presentation will be jointly presented by Wei Ming Fu and Ching Ji Chu, who work at the Data Management and Statistics Department of Central Bank of Malaysia. The title of their presentation is Carbon Footprints Beyond Borders, Quantifying GHG Emissions Embedded in FDI of Manufacturing Sector in Malaysia. Please, the floor is yours.
All right, so good afternoon, ladies and gentlemen, and all participants. So I'm Wei Ming, and presenting jointly with Ms. Chingy from Central Bank of Malaysia. So today we would like to present on our papers of carbon footprints beyond border, attempts to quantify the greenhouse gas GHG emissions embedded in the inward foreign direct investments, focusing on Malaysia manufacturing sector. So this work contributes to discussions on linking external sector statistics with climate-related measurement challenge. So the presenter is structured into 6 parts. So first, we will introduce the motivations linking FDI and climate measurements. Secondly, we will discuss on some stylish facts showing the importance of manufacturing in Malaysia inwards FDI. Thirdly, a macro-level mapping framework linking the intergovernmental panel of climate change, IPCC emissions, to economic sector, followed by a micro-level firm-based modeling approach. And finally, we will share some key limitations and implications for statistical development. So, FDI is the key driver of the industrial growth. Firms leave carbon footprint through industrial activities and other energy-intensive processes in their direct investment enterprise. So now FDI may act as a mitigator for climate change through knowledge or technology transfer on renewable energy, technologies, and infrastructure. Nonetheless, FDI could also lead to carbon linkage in countries with less stringent environmental regulations. So this motivates the studies to attempt measurements of the GHG emissions, as also recommended under the IMF Data Gap Initiative Phase 3. Cross-border productions network have enabled firms to fragment value chain, relocate stages of productions, and deploy capital where costs and capacities are favorable. So this complicates the emissions accountings. For economy pursuing industrial developments through the FDIs, the investment channels can materially shape the trajectories of territorial emissions and energy demands. Such is a salient case for Malaysia. And given that Malaysia development strategy has long been anchored on trade openness and inwards FDIs, to build globally competitive manufacturing cluster, especially on the E&E and machineries and related supply chain. So with the motivations, we will show why manufacturing is the key entry point. So based on the figures recorded in the past few years, manufacturing remains a dominant recipient of inwards FDI in Malaysia, as shown by both FDI positions recorded in the balance of payment statistic, as well as the approved investment reported by the Malaysia's Investment Development Authority. While services have gained importance in recent years, manufacturing remains a core destination for foreign capital. In addition, approximately 40% of the inward FDI stock originated from G20 economies, mainly from the Japan, the United States, and also China, thereby establishing a direct link between Malaysia's manufacturing-related emissions and the Data Initiative GAP 3 objective of enhancing cross-border environmental and financial statistics. So now with the key measurements challenge is that national emissions are reported in environmental classifications, while economic statistics use industrial classifications. So we start at the macro bridge. So at the macro levels, we construct a macro level benchmark from an exploratory mapping exercise to assess the GHG emissions associated with the manufacturing activities in Malaysia. That is by mapping the emissions reported under the Malaysia's Pioneer Transparency Reports, which follow a process-based IPCC classifications into Malaysia's standard industry codes of the economy sector. So to enhance the comparabilities with economic statistics, we apply an IPCC to MSIC mappings, a top-down approach to develop jointly by the Joint Committee of Climate Change, Subcommittee on Bridging Data Gap under the Central Bank of Malaysia, the Ministry of Natural Resources and Environmental Sustainability, as well as Department of Statistics Malaysia. And for information, the mapping is referencing to the 2006 IPCC guideline on the Volume 1 Chapter 8 reporting guidance and tables, where it standardized the IPCC classifications and reporting frameworks that consequently enables consistent mappings of emission-based category to economy classifications, which is the international standard industrial codes, which is then made further to the localized Malaysia standard industrial codes. So we operationalize it into the 5-step workflows. First is to identify the M6 sector for each IPCC sector. Second is to allocate the IPCC emissions into the MSIC sector and also apply a proxy where necessary. And then we validate via the technical working groups deliberations and also compose the sectoral GHG emissions by the MSIC sector. So the sector share formulas show is the simply emissions in the sector I divided by the total emissions. So in the IPCC views, so emissions are heavily concentrated in the energy sector, about 79%, and followed by the industry process and product use of 11.3%. So this sectoral structure implies that macro level measures of manufacturing emissions should integrate both energy-related combustion emissions and industrial process emissions, which are reported under separate IPCC category. So following the mappings to MSIC, the two sectors accounted for the bulk of national emissions: electricity, gas, steam, and air conditioning supply with around 35%, and manufacturing 31.9%. So this indicates that once emissions are organized by economic activity, manufacturing becomes the second highest contributors to national GHG emissions. And focusing on the manufacturing, total emissions are estimated at around 104,000 giga carbon dioxide equivalents, with forest affiliates accounting for approximate 40,000 giga carbon dioxide equivalents, apportioned based on the gross fixed capital formations, or GFCF, contributed by each subsector. As Scope 1 emissions in manufacturing are directly linked to the operations of the fixed asset, the GFCS ratios provide a more direct attributions of carbon's liability than output-based measures. However, this approach does not capture potential FDI technology premiums, whereby foreign firms, particularly the green fields investments, may exhibit higher energy efficiencies than the sectoral average. In addition, capital-light or fabulous foreign firms under the PPM7's factory-less gross product producers may record substantial investments in intangible assets without operating emission-intensive fixed assets, leading to potential misalignments between allocated capital shares and actual Scope 1 emissions. And it is also noted that the national GHG inventory is compiled on a territory basis and does not distinguish between domestic and foreign ownerships. In addition, the main risks of the mappings are definitional misalignments and homogeneity assumptions, especially because IPCC is process-based, while MSIC is an economy activity-based. So accordingly, the map manufacturing data should be interpreted as a contextual benchmark for order of magnitudes validations rather than direct measures of FDI-related emissions. The attributions to FDIs is addressed in the subsequent micro-level analysis. So now I would like to invite my colleague, Ms. Ching Yi, to present on the macro-level firm-based modeling approach and also the key limitation and challenge of our study.
Okay, right. At the micro level, the analysis actually shifts from a sector level aggregate to a firm level data. We are mainly using the audited financial statement and also the sustainability disclosure by the FDI firms in Malaysia as the primary input for our modeling of these GHG emissions, and focusing primarily on Scope 1 emission, which are most consistently reported and directly linked to production activities. This approach that we are using actually built on the recent literature by John Rowe in 2024, which demonstrates how financial variables can be used as a proxy to explain variation in emissions where direct disclosure are incomplete. The baseline set of explanatory variables selected for the analysis includes PPE intensity, revenue-related indicators, capex to revenue, leverage ratios, operating expenses ratio, and also trade intensity. These variables are selected to capture different dimensions of firm behavior, including production scale, capital intensity, cost structure, and external exposure, which are all economically linked to emissions outcome. While the regression results display an interpretable and positive coefficient for energy usage and revenue, our diagnostic test actually indicated a very severe heteroscedasticity and deviation from residual normality. As a result, the p-values reported here are interpreted as indicative rather than definitive. And future work on this shall incorporate more heteroscedasticity, robust standard errors, and additional sensitivity checks to strengthen our statistical inference. Okay, thanks. Right. To assess whether our assumed functional forms of linear models constrain our predictive performance, we introduced two non-parametric tree-based ensemble models, namely the random forest and XGBoost, as benchmark specification. This model actually allows greater flexibility in capturing non-linear relationship and interaction effects across the firm characteristics. The results from both models show broadly consistent pattern, particularly feature importance ranking indicate that energy is the dominant predictor for emission, while PPE intensity and revenue provide additional but substantially smaller incremental explanatory power. It is critical to note that this reflects predictive contribution rather than directional or causal effect. Besides that, these results reflect a fundamental characteristic of Scope 1 emission. Since these emissions are derived directly from fuel combustion and energy consumption is closely linked to fuel use, so the relationship between energy and emission become near tautological. As a result, the energy variable tends to dominate the model and absorb much of the explanatory power from financial or structural firm level variables. Yep. So next we go to the limitation and challenge that we face throughout the course of both macro level and also micro level study. We identified 5 key challenges and limitations that are important for interpreting the results. The constraints, first constraint is related to our statistics, the reference period, periodicity, frequency, and timeliness of the data disclosure. Our national GHG inventories are compiled and released at a multi-year interval. And for Malaysia, the latest data is only available up to 2021, which is about a 4-year gap as compared to the firm level disclosure. Secondly, as highlighted by my colleague earlier, on the methodological and definitional misalignment between framework, we have to note that IPCC compilation are classified based on process, while under the Standard Industrial Code, Malaysian Standard Industrial Code, MSIC, firms are classified based on their primary economic activities. Next, we have also coverage gap and also selective disclosure problem. As the data that we use here is largely derived from a publicly available sustainability report. So it tends to cover listed firms. As a result, privately held firms and also smaller entities are underrepresented, leading to only partial coverage. Next, we also have the homogeneity assumption, which is a problem here, as we couldn't assume that the energy usage by manufacturing activities of a subsector in electronics is the same as those that is in the oil and gas related manufacturing. And lastly, the most critical one would be the incomplete view of the capital formation by FDI, as the current usage of measuring apportionment using GFCF is only capturing a trade-based or flow-based metrics. Right. So, in conclusion, our study provides a practical measurement framework for linking the external sector statistics with climate-related indicators, particularly in the context of FDI and manufacturing emission. Well, robust modeling is necessary, but certainly not sufficient. And representative measurement of the FDI-related emission ultimately depends on the disclosure coverage and also a sound measurement design. Yeah. So the results are exploratory in nature. We highlight both progress made and also the remaining constraint that we see. In terms of improvement, definitely we see a strengthened sustainability reporting requirement, particularly for listed issuers. Yeah, and this increase in the capital market disclosure definitely provide a structural foundation for emission analysis. However, a biggest constraint remains that substantial shares of FDI in manufacturing actually operate in Malaysia through an unlisted direct investment enterprise, which are not covered under the existing disclosure framework. And even when the disclosures are available, they are actually often reported at the group or parent level rather than a level of the Malaysian operating entities. Looking beyond, we definitely hope that the challenge discussed about will lead to a broadening reporting coverage beyond listed firms.
and also definitely developing a structured data partnership with Statistical and other regulatory agencies, and also advancing a transparent statistical estimation method. With that, we hope this study provides a useful contribution to ongoing efforts to link external sector statistics with climate-related measurement. Thank you for your attention.
Okay, a big thank to both of you for your insightful presentation and also for your research, presenting your research that connects capital flows with climate indicators, which I think is very useful. And now it's time for the Q&A session. So I open the floor for questions. If you have a question, please raise your hand and we'll collect a couple of them.
Thank you. Yeah, thank you, Piotr. My name is Olivier Cirel from the Bank for International Settlements. Thank you very much as well for the presenter, excellent presentation. I just have two thoughts, basically, after listening to your talk this morning. One is a recurring theme is fragmentation. Basically, virtually all of you, both in this session and the previous session, talked about fragmentation. And fragmentation is kind of acting as this kind of centrifugal force that is pulling countries away from each other, or, as Rene, you said, pulling countries into blocks, regional blocks. So my question here is, when you look at fragmentation, are we comfortable to say that we are moving from a global economy into a more regional economy, where basically, you know, we have this reconfiguration across regional blocks? That would be question number one. My second question actually looks on the other direction. When you look at fragmentation, the antonym of fragmentation is integration. And this is where actually, Manfred, I really like your presentation, because you say, we are also going through integration so much that is leading to specialization, concentration, and potentially this is raising vulnerabilities for countries. And so here my question is, you know, are we comfortable to say that we are fragmented when you look at the real aspect of the economy, but we're still very much integrating when you look at financial aspect of the economy? So how does the interplay between real factors and financial factors plays there? Yeah, thank you very much.
Hello, Jan Baran from Narodowy Bank Polski. I have a question to Renan. You mentioned that there is a negative relationship between your dependent variable, which is this measure of friendship in FDI's linkages, and the geopolitical distance. And I saw that you have quite a long period of time since 2014. So do you see any changes, fluctuations in the strength in this effect, particularly after the COVID?
Maybe we'll collect.
Another question for Renan. So I understand that your research may be preliminary, but I would like to ask, if I may, that what do you think is the clearest empirical signal that global foreign direct investment is fragmenting instead of simply reallocating? By reallocation, I mean investment changing position. By fragmentation, I mean investment changing position, location, in such a way that it separates the global economy into less connected trade blocks. Thank you.
Okay, so maybe now if the participants can answer this question, and then we can move to another round of questions. So there were a couple of questions to Renan, I think, and so maybe you can start.
Hello? Okay. So to the first direct question, I don't have any hint about that. I think maybe the coefficient would be higher right now. But the panel that we ran was for all the years. So maybe that would be a good question for our next study. But I don't have the answer right now. That's a very good question. So how the global FDI network system evolves, that's a very interesting question to answer. And that connects also with your question. So in the start of the presentation, I talked about studying the microstructure and the mesostructure, but not the macrostructure. And I think having disconnected network like the giant component would be a very interesting thing to study, as well as the FDI space as an evolving complex system. Just as I said, I'm trying to benchmark with new measures right now, but that opened up so many questions that, in my view, I thought that maybe this paper would achieve like 100 pages, 150 pages, so I had to stop somewhere. But I'll be happy to talk to both of you to maybe call for a new paper or something like that. And regarding ODVE question, also it's more an open question. My hint is that we are reconfiguring the FDI system. I don't think that we will be like entirely fragmented between regional blocks, but let's see what happens.
Okay, Manfred.
I will mix both things that you said between fragmentation versus integration with the questions regarding COVID. Because it happened during the COVID pandemic. I already told you the main export product in my country is medical devices. So pandemic worked all the way backwards in our case because export increases and we experience a reallocation of the FDI that used to be somewhere else in the world to Costa Rica because supply chain of medical devices to US is just a flight of 2 hours and we're in the same time zone. And so what we experienced during the pandemic was we had that strong sense of reallocation within our country of FDI enterprises focused on medical devices. And since, yes, we have what we call zero season in tourism in 2020, we have a huge increase in the medical devices exports. And at the end, it didn't impact the overall GDP. It was negative, of course, but it was compensated by the production of medical devices. And we have huge FDI flows to our country at the point that now we don't have fresh, let's say, fresh flows, but mostly reinvested earnings, which is at this point 2/3 of total FDI in our country because medical devices enterprises grow a lot.
Would any of you like to reply to the comments or so? Yeah, Perla?
Just maybe shorter on the evidence of fragmentation. I mean, one of the motivations that why we decide to do this very big data set on ultimate exposures, it's because we didn't found in reality in our view, FDI fragmentation now is not a widespread phenomenon. I think we make a big research across recent studies, and I remember there is this IMF World Economic Outlook in 2023, where they make a claim that there are early signs of fragmentations. Well, that became the debate, and because the US, China, it seems that they were realigned in different ways. But well, whatever, it could be debatable, but what we really found is that effectively, as Manfred mentioned, there are probably early signs on industries. So in that sense, probably the official FDI statistic is not helpful for us right now to see these early signs of fragmentations at a specific industry level. But like the work that the ECB presented this morning using alternative commercial sources could give a kind of hint what is happening right now, you know, as announced or predicted trend on FDI fragmentation.
Okay, we have a couple of more minutes for questions, please. Sorry.
Good afternoon. I'm Łukasz Jak from Narodowy Bank Polski. I have a question for Perla. There's been a bit of discussion on UI reporting recently, and I have a methodological question. Whether you managed to keep some consistency in reporting method, because some countries report winner takes it all, some countries report proportional ownership. The figures might differ a bit. So I'm just curious whether you somehow adjusted the data or keep consistent. Thank you.
Maybe now in the second floor.
Nadia from the Swiss National Bank. So my question is also to Perla, but also to Renan, working with cross-country FDI data. So for economists, it's of course crucial. Direct investment, we see it as real linkage to the economy. But countries also compile direct investment statistics using different valuation methods. Since especially you, Perla, you are rebalancing this metrics, sometimes using also mirror data, is there a way to have some kind of robustness with countries that are actually using the same valuation methods to see if your findings hold or results differ? Thank you.
Please.
Many thanks, Robert Kirchner, Deutsche Bundesbank. I have a question to our colleagues from Malaysia, because you mentioned sustainability disclosures to overcome certain problems that you have with the timeliness of official statistics. And you also mentioned the big problem that it is very often only reported on a consolidated basis on the group level, etc. So we are facing a similar problem in Germany. So I would be very much interested in your recommendations that you could give based on your data, how to break it down to a national level or to all the subsidiarities. So any ideas on doing it and what could work in practice? Thank you.
Okay, thank you. Now, let's give the opportunity to our speakers to reply. Perla would like to start.
Yes, thank you. Thank you for your questions. Yes, it's not evident, right? Yeah. The key in our methodology was rely as much as possible on the FDI statistics that the countries report directly to the international organizations on immediate basis. This is because it's based on the benchmark definition, and this is all, when they reported directly to the OECD or the IMF or the Eurostat, this by IMC, it's already standardized. We are, of course, under the recommendations of the benchmark definition. We know that countries face different kind of methods when they compile the microdata and they arrive and achieve the aggregate data that they report to the organizations. The other issue, probably we didn't mention it, it was, I think that the main issue, and it came with the balancing thing, it's because countries also report data that it's confidential, so we don't have the data there, no? So what we are going to do? So this is why we decide to do a more micro estimate country by country when we saw that there were holes in the time series by bilateral country pairs due to confidentiality. because that was a sign that, okay, the data, it's already standardized, but for a reason, the data, it's missing because there is a crucial confidentiality issues here. That means the country pair exists, so the economic relationship exists. It's not that we just fill in the whole matrix and create fake bilateral relationships. So we take into account that confidentiality, and we saw, we realized some interpolation or extrapolation, pretty measured according to the country nature of the trend, and we incorporate that input as part of the balancing procedure. But we carefully make and measure our weights with the idea that the balancing procedure do not change too much the values where we signalize that a high quality value, it could be those reported directly to the international organizations because they were already standardized, and those that we derive from our alternative measures, and those that are interpolated but confidentiality are not in the highest, are in the highest rank of quality because of the confidentiality flag. So that means that we trust in the mean that the countries report directly to these statistics.
Okay, colleagues from Malaysia.
Hello. Okay, right. Thank you for the questions. And indeed, we recognize this as a major constraint, as the group level reporting really weakens the entity level attribution. Yeah, the immediate remedy that we can think of, definitely better granularity in disclosure, direct partnership with the data source itself, the entity itself. But this is not always feasible. So based on experience from our studies, the next steps that we are looking into is, as the modeling itself is not able to give us at, I would say, at the numerical level, the data. So we are thinking about actually do it based on a broad base. So actually segregating the firms into different subsectors, and further from the subsector based on their energy profile, and further apportion the energy profile based on something that is like a low, medium, high instead of exact numerical quantifying method. Yeah, so that is what we are thinking of at the moment. Right, thank you.
Okay, thank you. And there was, I think, one question for Renan as well. Please be brief.
I agree with everything that Perla said. From a compiler and researcher standpoint, doing cross-country is kind of wild. You know, we never know where we are standing. So we have many issues, and we also have worldwide questions about this. We have working groups on financial asymmetries, on FDI asymmetries, and we have to choose one solution for all of those issues. Perla presented an amazing solution, and I want her data on that. But in our study, what we did was to be more confident on inward data than in outward data. And we couldn't go further to study valuation issues, or even maybe to compare what would be the differences between what were reported by the inward country and the outward country. So that's methodological stuff to do afterwards. And that's my view on that. Okay.
Okay, so now it's time to wrap up the session. So I would like to congratulate all of our speakers for doing a fantastic job, and thank them once again for presenting the research, for coming to Kraków a long way from different continents. Thank you once again, and please join me in giving a warm round of applause to all the presenters. And I think now it's time for the lunch break. Thank you.
Gentlemen, ladies and gentlemen, please take your seat. We are about to start. So, my name is Rafał Woś. I'm an editor-in-chief at Solidarność Weekly. This is traditional Polish free press outlet. I'm also an established economic commentator and quite a prolific author of a couple of economic books, 5 of them actually, with 6 on the way. The 6th will be a biography of Polish złoty, Polish national currency, and a kind of strong case for never ever giving it up. But it won't be about me today. I will be merely a host for the next 1.5 hours. And we will have a very interesting afternoon, I suppose. So, first of all, let me invite to the stage our panelists. It will be Gian Maria Milesi Ferretti. Please, if you are with us, join us here at the stage. It will be also Pinar Yesin. If you don't mind, please join us too. And last but not least, Piotr Żuk from National Bank of Poland. We invite you here to the stage, but our very special guest is Fritzi Köhler-Geib from the German Bundesbank. She is a member of the executive board of a German Bundesbank and responsible for IT data, statistics, risk control and research center. Before that, she was a chief economist and first vice president of KfW Group. This is German for Kreditanstalt für Wiederaufbau, kind of a Marshall Plan era development bank co-owned by German state and Bundesländer. Her research focuses on financial crisis, their stabilization, growth enhancing reforms. She also teaches at Goethe University in Frankfurt. Professor Köhler-Geib will give us her perspective on measuring geoeconomics fragmentation, evidence, statistical challenges and opportunities. Please join us here. We are very glad to have you here. Yeah, the speech is scheduled for 20 minutes, and after that, Professor Köhler-Geib will join us here on the stage, and we will have our panel round table.
Yeah, thank you very much, Rafa, for this very kind introduction. It's a very great pleasure and honor to be in this distinguished panel, and also having the opportunity to speak at this conference with so distinguished researchers and statisticians. And yeah, I think the topic of the conference is extremely timely. I think we are all thinking and grappling with the geopolitical challenges, thinking about what opportunities they could deliver. And I have to say that when preparing for the speech, I thought about my last holiday, because I was with my family in Siena. And I would like to share this message from the 14th century with you. It's a fresco by Ambrogio Lorenzetti, and Gian Maria will maybe forgive me my pronunciation of the Italian name, but it's an allegory about good government, here on the left and top, of what good government is and what it leads to, ultimately well-being, prosperity, and on the right-hand side, bad government and what it leads to, violence, death, and basically poverty. So now you wonder, wow, why did she think that was relevant for our conference? Well, because to me it's very obvious, good government needs good decisions. And good decisions need good evidence and good data. And to me, the question that we have to ask ourselves is, in these times of geopolitical challenges and fragmentation, how do we provide good data, good statistics for good decision making? And I would like in the next, now maybe Rafa, I have 18 minutes left. In the next 18 minutes, I'd like to go through this overall question with you with the help of three smaller questions. First question, what do we take from the current environment, and what are the policy and statistical implications of those developments? Second question, how can we provide relevant objective data faster and in a more user-friendly way? Because it's also true, in this geopolitical environment, we also have an environment of fast technological change, and that also impacts what we are doing. And then third question, how do reliable statistics contribute to democracy, and what responsibilities does that entail for us? So let me start with the first question about the environment and its implications for economics and statistics. You have already this morning discussed about the economic side of things and also fragmentation. I just want to throw after lunch one picture to bring you back into the topic. We can see that global economic policy uncertainty is at levels that we haven't seen in a long while. I mean, not since this particular indicator, which is a text-based indicator of economic policy uncertainty, has been created. And these levels of uncertainty are to a large extent also driven by the geopolitical developments and also by fragmentation. There's a lot of research going on. You have discussed this morning in the panels. There's also Bundesbank research that shows that countries that trade with countries that are subject to geopolitical risks face lower import levels, higher import prices, and disrupted supply chains. And there's a lot of research in that direction, more on the trade side than with regards to financial flows. I do want to point out a paper that was published in one of the monthly reports by the Bundesbank recently, where my colleagues have looked into the changes in asset positions since the onset of COVID in 2019. And as you can see here, the assets are divided into, and this is basically German assets, divided into being invested in the West, meaning the US, neutral countries, a number of other countries, and I refer you to the report for further detail after lunch, or to the East, meaning China in this study. And what you can see is that while we do see already impacts of those geopolitical changes in other investment and in portfolio investment in the two left panels, in terms of foreign direct investment, which is understandable because this goes along with physical investments, you see much less impact in a statistically significant way. So a lot of this analysis is taking place, and I already heard feedback that it was very interesting to also see the use of micro data to basically validate also macro flows. There are some real challenges with external account data, and one of the most prominent examples are the asymmetries in the euro area current account balance with the US. As of 2025, when we look at ECB data, we see a current account deficit of 57 billion euro. So basically negative balance, while when we look at the corresponding data by the Bureau of Economic Accounts, it's a 9 billion euro surplus. So overall, the asymmetry amounts to 66 billion euro, which is quite significant. And then I promised Martin that I will mention his paper. Here we go, Martin. You presented last fall your paper on the development of those asymmetries over time at the last fall's IMF Statistical Forum. And what we can see is that they have been quite substantial over time, but that they have even reversed in sign and have not been stable, which also means that, of course, this analysis about fragmentation and about relationship between different countries becomes very complicated. A lot is going on to address these difficulties, and I'm sure it's not the first time that you heard about this. So I want to bring to your attention the databases of the OECD and the IMF that basically allow an overview of bilateral asymmetries. We also have the BOPCOM a subgroup on asymmetries that is looking into this issue and is preparing a report on that. And we have further initiatives, as for example, in the institutions also large case units that address some of the challenges. Because of course, when we go back to the large asymmetries, that brings up very unpleasant questions. Whose data is correct? And where do these asymmetries stem from? And some of the reasons also have to do with the complex structures of international corporations, or also different compilation methods or estimation methods. And of course, it's important to bring this together and to address this. And while these initiatives, including also the large case units, are very helpful, we may even have to go beyond this. And I would like to bring a concrete proposal to this conference, and that is to make a recommendation to the G20 data gap initiative to include a recommendation on reducing international asymmetries in statistics. So let me summarize the answer to the first question, which is that, okay, we are in an environment of high economic policy uncertainty and geoeconomic fragmentation. We do see large asymmetries. They limit to a certain extent to answer policy-relevant questions, even though we also have workarounds for the analysis that we've seen. And then thinking about a way forward, a G20 data gap initiative recommendation on lowering asymmetries could be a driver of the change. So let me go to the second question then. How can we provide relevant, objective data faster in a more user-friendly way? So I don't know if that has ever happened to you, that you were in the need of some data. I'm sure it has not happened to you, because I'm sure you have the data available. But it's true that a lot of students and people just go to AI models to seek answers to questions about the economy. And the truth is that the large language models are language-based and give you the most probable answer that probably sounds good, but also probably is wrong. So the question is how to address it, and I was very pleased at the spring meetings in Washington to learn about the effort of StatGPT, which is developed by the IMF in collaboration with other institutions, which basically provides statistics, official statistics, in a very user-friendly way and combines different data sources and makes sure that those statistics are then also fed into large language models so that we have a higher probability of getting better results. And this is one initiative among others. Of course, there is also the whole work that we've seen in Europe that basically has been reducing asymmetries within the European Union, but this is possible because of European legislation, which cannot be easily transferred to other jurisdictions. So when it then comes to ways to deal with those challenges, I want to bring you some examples from Bundesbank, because there are a lot of initiatives going on in all our institutions to address these challenges of the time it takes to produce reliable statistics. And when it comes to faster production, I would like to mention the statistics on securities, where we have changed our production system and reduced the production time from weeks to days. Then when it comes to better products and services, which can also be a way forward, I'd like to mention our platform, our integrated data analytics platform, which is an internal marketplace where colleagues, economists, researchers can combine different data sources and use them for their analysis. And then also very important is stronger data governance. And in this context, it's important that we basically put up data catalogs and a better overview about the products that are available for our colleagues. We also have a financial data management unit that oversees the purchase of external data that are brought into our institution for the use of our colleagues, and to have a faster, easier, and also more coordinated access. What is a challenge, though, is the occurrence or appearance of new challenges or themes and their representation in statistical standards. That often takes a very long time in also international cooperation. And I would like to bring one example, the emergence of Bitcoin. So the first Bitcoin transaction happened in 2008. Then we had several steps. And now we are in the process of having a white paper for the standards on how to report crypto assets, which will be implemented over the next few years until 2030. So when we take this very incipient point of 2008, which is a bit unfair because you have rather in 2017, you had Japan that as the first country accepted Bitcoin as a means of payment. So we could also start in 2017 to count, because we cannot pick up all developments that may be out there. But it does show that there is quite some time lag before that really is represented in standards of statistical data provision, which is also clear because there need to be manuals on how to compile. There are a lot of good reasons why adhering to the principles of providing reliable, impartial, and good data takes quite a bit of time. And at the same time, with the technological developments that we see and the competition from sources that are much less reliable, but just so convenient for people to use, it is also a good idea to really think about how can we reduce the time span until we have those standards in place. And in that sense, I would like to suggest that we start to work with rolling recommendations via the G20 Data Gaps Initiative, because they could accelerate the process. So far, we have a revision process where we go through basically it's an all or nothing approach, where we go through all standards and then have an overall revamp, and it could be a very good idea to do this in a rolling manner to save on time to come to new standards. So, the answer to the question that I posed, how can we get to objective data faster, is basically that we need to use more flexible and more user-friendly approaches, and that one way is also to adapt international standards and G20 data gap recommendations on a rolling basis. And this brings me already to the third question. How do reliable statistics contribute to democracy, and what responsibilities does this entail for us? And here I would like to bring to your attention a study by OECD that basically shows that reliable statistics are linked to greater trust in democracy, because we can see that people who always or often say that government institutions provide statistics that are trustworthy have a 4 times higher probability of having high trust in national governments. And in Germany it is even a factor 6. And it's also true that government institutions that provide statistics that allow you to verify whether governments keep their promises have a double as high chance for people to have a high trust in the national government, in Germany even 3 times as high, than for those people who rarely or never say that their government institutions provide statistics that allow a verification of what those governments are doing. So that is basically to show that statistics do matter. And then, of course, the question is, how do we achieve that? How can we reach people? How can people be aware of the statistics that are available? And here, I'm sure that there are also a lot of, and I know there are a lot of initiatives in a lot of the institutions that are represented here in Bundesbank. We have just published a new web portal where it's even easier for researchers to access our data in this effort to making statistics available in a broader and easier way. And of course, the responsibility that goes along with this impact on trust in governments is also very relevant. And we have principles that are laid down in the UN Fundamental Principles of Official Statistics and others. And there are a lot of speeches by Madame Lagarde, by Isabel Schnabel, or also by Joachim Nagel that also have references, can be used as references to those principles in our statistical work. So let me summarize the answer to the third question, that independent official statistics are a public good and are highly relevant for our democracy, and that active and ongoing statistical communication is part of our responsibility. And so I think with the third question, I made a link back to the message from the 14th century that I started with before, that in particular in times like these, and I'm sure that between the 14th century and today, there were a few times where there were some geopolitical challenges, that it is even more important to adhere to high standards of providing reliable and impartial data, and that is a contribution to our democracy and freedom. And I thank you very much for your attention. I'm very much looking forward to our discussion.
Thank you very much. I just wanted to pour you some water and ask you how do you feel? Are you ready to answer one more question from me or too tired for that?
I'm happy to answer questions, but I'm also very curious to hear from the other panelists.
Yeah. Yes, you will. Yes, you will. But first of all, please let me ask you, because it's quite connected with what you have said, and this is the thing that I have always wanted to ask to someone with your experience, institutional experience. I have a friend who used to work for the World Bank. And he said the first thing that he has learned by working for that institution was the following: torture the data until they confess. That means that all the institutions that have all the data in the world, they can deliver very different answers, which are very much connected to the question that needs to be answered. So I wanted to ask you. You've been working. You have a wonderful career in all of these famous institutions: the German Bundesbank, IMF, World Bank. Do you think the problem is real? That the problem that we are fishing in this pond and looking for the answers that are the first is the answer, and then there are the data. They need to give an explanation to that. I'm just very curious how you see it from your perspective.
Yeah, that is a tough question, even though I would say I would divide that in two. Because, so one is the integrity of the data. And as we have discussed, no, there are the UN standards and principles on providing impartial and reliable data. And what you said is precisely why it is so important to have those principles and to adhere by them. It is also exactly the case of those suspicions regarding data that we address asymmetries that we do see in the data that arise from very natural challenges, as we may have different methods of data compilation, or we may use different methods of estimation. And for those purposes, the exchanges in these international fora are so important to reduce those, and we need to find ways to come to a better understanding, no? And then we also have, as I mentioned, those international corporations that may also add to the challenge. So I do think that it really is a very responsible task to provide impartial and reliable data. That's one. That's the integrity of the data. And then there is the integrity of the researcher. And I think this is also very important. And I must say I have encountered, and maybe I was very lucky, a different World Bank. And I was socialized with a very strong value of integrity. And that, I think, is that when we ask ourselves a question in research, we need to be sure that we are open-minded regarding the result. And when we are not, I think that is a tremendous risk.
Thank you very much. Let me just now open the discussion, our round table, to the other participants of the table. I will now introduce them, although I'm sure you know who they are, but still, we have Gian Maria Milesi Ferretti from the famous Brookings Institution, where he is a senior fellow in the Hutchins Center of fiscal and monetary policy. I might not look like one, but I have read a lot of your papers, so I'm a kind of a fan of your work. He's a former deputy director at the IMF, research development. His research focus on international capital flows, financial integration, global imbalances, capital controls, taxation and growth, and political economy. Is it correct? Okay, so I will ask you about global imbalances, if it's possible. Because I've been active as an economic journalist for almost 20 years, and for as long as I can remember, the topic of global imbalances was there. The US being in permanent trade deficit with China, imbalances inside Europe, persistent trade surplus of Germany as a factor tearing the Eurozone apart. It has always been there. Right now, we have this new talk of the town, which is geoeconomics tensions. We are talking about this today. But to me, these tensions are mostly the direct consequences of those persistent global imbalances, aren't they? They are like trigger the tensions, don't you think?
I think it's one factor, but as you say, some of these imbalances have been quite persistent, and yet we have seen an evolution in the extent of tensions. So we did not have geopolitical tensions of this order of magnitude a decade and a half ago. So something else is clearly at play. I think a lot depends also on how you define what imbalances are. So I think most of the attention is on whether countries are running large current account deficits and surpluses on the flow side, and on the position side, whether countries have large creditor or debtor positions. The two are obviously related, they're not exactly the same thing. I think that the reasons for the widening of imbalances in the past few years, at least on the US side, had very little to do with geopolitics and very much to do with basic macroeconomics. The US has huge stimulus, had huge stimulus coming out of COVID, much larger than other countries. That mechanically tends to boost US demand and spending, and hence drives up imports. The US had a technology boom, which at the same time encouraged foreign investment in the US, but also boosted US wealth through higher equity valuations. And higher wealth comes with higher consumption and higher investment as well in those sectors that are producing these gains in wealth. So that's, in my mind, very much of a macro story explaining why the US is running a large current account deficit. Where I think we have to look to see the impact of geopolitical tensions is on bilateral financial linkages across countries. And there, over the past decade or so, you see shifts. And I think the most salient one is the shift in China's decisions as to where they would allocate the proceeds from the surpluses that they have run during this period, which used to be primarily invested in US securities, but are now invested elsewhere. So while it is true that China had large trade surpluses vis-à-vis the US, there is nothing that compels countries to invest in those destinations where their exports are directed. It is true in the aggregate, of course, that if you run a current account deficit, you're going to need some net foreign investment in the country. But it is not true that if you run a bilateral trade surplus, that means you're acquiring claims on the US. So China has invested its surplus dollars, if you want, elsewhere, in other emerging markets, providing dollar liquidity to financial firms investing in FDI in other emerging markets, investing in Europe, very often indirectly, and so on. And there you see quite a major shift. So if you look at aspects of integration and linkages across countries, you see that the primary creditors of the United States are its allies, other advanced economies. So that's how I would characterize, in a nutshell, sort of the impact of geopolitics on finance. China has clearly worked to reduce its dependence on the rest of the world, has worked on reducing its financial exposure to the United States. And that's very clear in the financial data.
Okay, thank you. Thank you very much for this inspiring insight. I would like to go a bit deeper, but I will stop here since we have still our both panelists to be introduced. Let me start with Pinar Yeshin. She's an economic advisor at the Swiss National Bank and lecturer at the University of Zurich. Her research interests are in international finance and monetary policy, particularly cross-border financial linkages and foreign currency lending. Since Gian Maria has mentioned it before, I would like to ask you, how do the current geoeconomic tensions influence international finance and financial links? I mean, is it really that different to what we have had like 10 or 15 years ago? Is the world living in right now so really different?
Thank you for having me, first of all. I'm also honored to be part of the conference, in addition to being part of a panel with distinguished speakers. Yes, now it's different. Why? Because we have huge, or the world is interlinked the most that we have seen so far, historically, right? But we had different spells of, or waves of financial integration and then fragmentation in the previous century between, I'm no historian, I had to look that up, but between the world wars, for example, or after the global financial crisis within the euro area, how the sovereign debt shifted among countries. So it does happen for various reasons. It's not the first time, but now the volumes are huge. Not only among advanced economies, but even with emerging market economies, where Gian Maria has previous research showing it's small, but it's growing, that the linkages are big. Global value chains, real linkages, big. So any realigning, rewiring of these linkages may have huge consequences for the real economy. For efficiency reasons, welfare effects, they can be big. It's difficult to forecast what it is or what is right now happening. We have to work with the data that we have, and I'm grateful for all the data that compilers are putting together. It's a huge task. I also realize that. I am a data user, so I can complain about the data maybe, but I will use it nevertheless, and I do appreciate that it's there, because without that, we cannot do our business as economists. We cannot give evidence-based recommendations or ideas. We would be jobless. Let's face it, nobody would trust our word if we cannot show the evidence. So high-quality data comes first. Balance of payment statistics, international investment positions are big in gross terms. So I'm not talking about global imbalances in net terms. just gross financial assets, financial liabilities, trade, exports, imports, services growing. We are interlinked more than ever. And we work with the data that's available. It comes, unfortunately, with 3 limitations, in my view, as a data user. For, say, GDP, we are used to think in terms of residency-based, so balance of payments data follows the same principle, it's residency-based. Multinational enterprise groups don't think like that. For them, it's not important, actually, this national border. I usually think of them as octopuses with many arms. So in our data collection, we are just seeing parts of the arms, maybe not even a full arm, maybe part of the head, who knows? And then we are trying to guess what the octopus is doing. We are just looking at one box and trying to say, oh, more financial integration, less financial integration, we should worry. We should try to look beyond that residency principle, complement with other data to actually say reliable, robust things. So that's number one. It's maybe the most difficult to, solve. Although I did like, if I didn't misunderstand, Philip Lane's comment about euro area consolidated M&Es. I'm like, yes, go for it. If anyone can do it, it will be the EU. So that's number one. Number two would be the component view. We talked a lot about FDI, very interesting. But that's only one type of investment. The M&E has a complex balance sheets, right? So it has other investments, so intergroup lending. It has FDI equity, so participation versus debt. So with a maturity, a loan. It has issues portfolio stocks that are traded sometimes in multiple countries, the issuance of a large M&E. That component view is, I think, misleading the economists. So we think FDI is moving independently of the other investment or of portfolio. For banks, we found some kind of solution, right? Consolidated banking statistics, thanks to the BIS and thanks to banking regulation, probably. We have some idea of what it means. For non-financial corporations, we don't have that solution. So that is something that we should be aware when we work with the data, because as data users, we have the responsibility to use it in a wise way. And then the third limitation, if I may add, is this missing granularity, although we have already seen this morning, there are some papers that are trying to bypass this issue and look at the M&E as an entity doing both direct investment and services trade. Because it's the same M&E. They don't do just one thing, they do multiple things. So we should somehow link those actions with each other and then say, because of fragmentation, maybe they are changing their direct investment, that will have implications for the services, if I may take that example. So those three limitations need to be pronounced a bit more, and the user should be aware of those and not take the data as given. Read the manuals that our IMF colleagues are putting together. I know it takes long, but it is very important, and there are data users who are reading them through and through, trying to decipher what this means. Overall, this conference, in my view, is the best conference because it puts together the data compiler and the data user. And there's the dialogue that is essential so that better data can be produced and used. So it's our, I think, shared responsibility before we can say if there is a fragmentation or what kind of effect it will create, we should make sure that we use data wisely. Thank you.
I like the distinction between data producers and data users. Who is the data producer among you? Hands up. and who feels himself as data user? Oh, we have much more data producers than data users here in this room, which is also interesting story. Thank you, Pinar, for that, and thank you for your wonderful metaphor of octopus. So, dear data producers and dear data users, beware of octopuses. And we still have Piotr Żuk with us, Narodowy Bank Polski, National Bank of Poland. Piotr is Deputy Director at the Economic Analysis and Research Department. He used to be an economist for the National Bank, worked for European Central Bank, for the Chancellery of Polish Prime Minister, Ministry of Economy. So he also has a vast experience in policy, different policy-making departments. His interest is on monetary policy and financial stability, capital flows, pension economics, and real convergence. But since we are here in Poland, and Poland is an interesting place to live and interesting story to tell, so let me ask Piotr about Poland, about all of those geoeconomic risks that we are facing now, and their impact on the Polish development, on the Polish growth. How do you see it?
So, good afternoon once again. First of all, it's my great pleasure to participate in this discussion alongside such distinguished panelists. So I would like to thank the Bank for International Settlements, the European Central Bank, and Narodowy Bank Polski for the invitation and giving me this opportunity to be here with you. But coming to your question, maybe I'll start with an observation that in principle, trade openness and globalization, it was one of the drivers of Polish success convergence. So when we discuss very often the success of Poland's convergence, I think it couldn't be possible without, growing openness to trade. Just to give you some numbers, 3 decades ago, Poland's trade openness was 45%, so imports plus exports to GDP was at the level of 45% of GDP. Now it's close to 100. So 3 decades ago, Poland's share in global export was at 0.5. Now it's 1.6, right? So it has more than tripled. But today, the environment, I think, for growth of exports and inflow of FDI is much more challenging for the Polish economy. And there are, I think, multiple reasons and multiple drivers of that, and some of them were discussed already during the previous session or in this panel session. So maybe I will point to 3 of them. And the first one, we think, is slow growth in euro area, or in particular among our main trading partner, Germany. We are deeply linked within global value chains and deeply connected with the German economy. Just to mention that 10% of Polish value added is absorbed either by domestic demand, domestic final demand in Germany, or is absorbed by the German export, right? So we do not only sell goods to the German economy, but we also like final goods, right, to be consumed or invested, but we also sell intermediate goods to Germany, which are manufactured then, and then they are sold in more distant markets, such as, for example, China. So this low growth environment creates challenges to Polish manufacturing and exports, and we can see this in the data in recent quarters and years when we have slower growth in manufacturing or export than it was the case before. The second challenge, I think, is related to China, and it was also already discussed. But what is, I think, very relevant is that this rise of China is asymmetric for Polish economy. By asymmetric, I mean that it's visible mostly in the imports data, right? So when we look at import statistics, 3 decades ago, again, Chinese share in Poland's imports was at close to 3%. Now it's close to 16%, and it's steadily rising. But on the other hand, we don't see so much export to China. Exports to China is less than 1% of Poland's export, right? So this is an asymmetric rise. It creates some opportunities. For example, Polish producers can buy cheaper goods from China, intermediate goods. We calculate that the average price, unit price of goods bought from China is like of 50% of the price of goods that are imported from other destinations. It provides a disinflationary silver lining for central banks, which is very positive, and it was very positive for the disinflation in Poland in recent years. But it creates very significant challenges related to competitiveness of the economy, especially as the structure of Chinese export and the structure of Poland's export to a large degree converge, right? So it's a direct competition to Polish producers in terms of, let's say, furniture, electronical devices, motor parts and vehicles, and so on and so forth. So I would say that that these are two challenges. There are many others, of course, but what I think what will define the future of exports and in Poland is a move from price-based competition, which was the case in previous decades. Still, level of price in Poland is much lower than in other economies, but I'm not sure if it's true for Kraków and the Old Town, but you'll have a chance to see if the prices are lower. But this will be crucial to move from this price-based competition towards more quality-based competition. And fortunately, this process is ongoing. We see this in the quality of exports. We see more technologically advanced goods and services, like, for example, IT services exported by Poland. So I think this will define the future of Poland's competitiveness and export going forward.
Okay, thank you very much. Since we all know that past behavior is the best predictor for the future behavior, I would say that there will be some, if not many, questions from your side, from the audience, since you were quite active in the previous sessions as well. So we still have a little more than half an hour for your questions and some answers. So let's do precisely this. I think we can take some of your questions. Are there any questions? I believe there are. There's a gentleman on my left-hand side. Microphone is coming.
Thank you. I'm Alan Holst from Eurostat. I have 2 questions. The first one for Fritzi. You show there's a link between good statistics and good government. And in your slide, the direction of the arrow was from statistics to government. So I was wondering if the causality could be the other way around. And then for Gian Maria, I wanted to ask what can be done with global imbalances in practice, because we read a lot of analysis and it seems to be a consensus that there's a problem with US fiscal deficit, with China's internal domestic demand, with EU productivity. But what's the next step? I mean, what can be done? I mean, should there be maybe a multilateral organization that penalizes countries that have persistent imbalances, or is there other way to solve this? Thank you.
Thank you. Let's start with Fritzi.
Yeah, thank you very much for pointing that point out, because I think it's fundamental that statistical data provision needs to be independent, and that needs to be protected. That's, as I said, it's a very, very precious good. Is this under threat? Yeah, that is under threat in various different contexts, no? And I'm sure that messages from the 14th century would apply today. And in that sense, I think that, that this discussion, and we have discussion about central bank independence, we are also providers of statistics, goes in that same direction. It's a very precious good that is absolutely to be defended, and are there over time differences? Yes, there are. And I think also in that context, it's so important to have those UN principles, to have international fora, to put data together and have very many different ways in which we can check how statistics are prepared, and also what the outcome then is, and whether we have consistency across different statistical data sets.
And before I pass the microphone to Gian Maria, let me please accept my apologies, because I feel I establish you as a kind of a imbalance, global imbalances explainer here on this stage, and the question is precisely about that. So I hope you don't mind being in this role, but I think it's crucial and very interesting. So if you could take this question, it will be very nice of you.
No, thank you, and thanks, Alan. It is I think a very good question. As you know, I don't have my IMF hat anymore. I can be just very direct. I think the odds of policy action in the directions you point out to address imbalances is very low, to be charitable. I think in the US, while there is consensus among economists that the trajectory of fiscal policy is ultimately unsustainable, that there will have to be a correction, I think the odds of that materializing in the near future is extremely low. As for China changing its development strategy, thank you very much. I don't think that's coming. I do think that there is a difference between their policy strategy prevailing at the time of the first round of global imbalances, where it was really mercantilist, keeping an undervalued exchange rate to maximize exports. I think now there is really an attempt to dominate critical industries while at the same time reducing their dependency on the rest of the world in a number of critical sectors. That, coupled with a very dramatic housing bust, is resulting in very weak domestic demand and de facto an export growth, net export growth strategy that is contributing to these, this growing surplus, these global imbalances. Again, I don't think they're explicitly targeting a large surplus, but this is the combination of putting their resources in manufacturing and having services fail to absorb very weak, having very weak domestic demand that does not contribute to services. Now, as people in policy organizations, policy organizations normally think of, you need policies to change things. But very often it is markets that change things. The period of global imbalances came to an end not because of policy action, it came to an end because markets woke up to the fact that some of the lending that was underpinning these imbalances had some pretty flimsy foundations. So it is very conceivable that we will see an adjustment that takes a different form. It could be a sharp correction in what we see as future prospects for profitability of some of these giant AI companies that at the moment everybody is thinking will be absolutely dominant. There's no question that the technology is going to change the way the world works. Whether the valuations are fully warranted, it's a different question. A correction in US equity prices would weaken US demand quite a bit, would probably go at the same time together with a weakening of the dollar. That could lead to a pretty sharp contraction in the US current account deficit. Similarly, we are in a period where interest rates are relatively high, but if you have a slowdown and you may see further upward pressure on the RMB, and it's going to be interesting because China has a large surplus, and it would be interesting to see how they handle that, because if their exports lose price competitiveness and you have weak domestic demand, you'd have to address the lack of growth coming from net exports through some other means. And that too could contribute to a contraction in imbalances. Again, this is not a forecast. I'm saying we shouldn't just obsess on saying imbalances will remain, will continue to grow unless policy action is taken. As I say, we probably want policy action if it's a sensible policy action in the first place. But imbalances may change because of other things happening. And considering the amount of global uncertainty, Fritzi highlighted the graph is very telling. The odds of shocks changing, say, market attitudes at the moment, we are very insouciant about the war in the Middle East. The energy shock is a massive one. If things don't get solved very quickly, that's going to percolate on the real economy, and we'll see what market valuations will do under those circumstances. So I'm just saying lots of things could happen that would trigger a correction. In my list of that lots of things, policy actions come, relatively speaking, at the bottom.
We, of course, don't want Gian Maria has any monopoly on the topic of global imbalances. So if the other participants would like to comment on that, you are very much welcome, if you wish. Wish you?
Sure, if I may.
Okay.
So knowing the challenges that the data brings, so sometimes policymakers read a bit too much into the level of the current account balance. We have done some work at the Swiss National Bank. I know at the Dutch Central Bank there is work done on retained earnings that are missing in the current account balance compilation, especially for small open economies with large stock markets where the holder of the security is abroad. This part is not compiled in the current account balance, and it can be big for some of the small economies. That said, the current global imbalance discussion focuses on large economies. The US in particular, China, to some extent the EU, I think. So at the moment, small open economies are not in the spotlight, but the debate evolves over time. It can change, the numbers change also given shocks and everything. So who knows what the future brings. Again, policymakers need to be careful about reading the data and thinking about what may be missing and whether the current account balance alone is enough to tell that there's a risk looming. We are a bit past those old times with balance of payments crisis, I would say. Maybe too naively, I'm not sure, but countries have large reserve assets, so real flows can adjust quick. Of course, domestic economy would suffer, but it's not like in the 90s or 80s or early 2000s maybe. It's a bit different time, so time is also changing. We should consider the financial shock. So if there's a market correction in the US, how will that affect the pension funds in other countries where they are investing, for example, in securities and are happy with this growth of the wealth, external wealth? How will they fare faced with this shock? So there are financial implications of the gross positions and gross flows that we should be a bit more sensible about, I think.
If I could add to that, because I really like the point that Pina made on not putting too much emphasis on the size of current accounts, and at the same time it's true that if you see imbalances over a longer period of time, there are some underlying structural themes. And I'd like to comment on that from a European perspective, because I think there are, when we think about, in particular, innovative technologies, there is way to go for Europe to make it easier for innovative young companies to grow. No, that would have a huge impact on the growth trajectory of the continent. And I think this is a topic that one could use such imbalances as an impulse to act upon. And that goes back to what Gian Maria said, that it need to be good policies to begin with. No? So there are things that, yeah, when you think about those imbalances, you may have a larger pressure through that lens, but as a matter of fact, these are policies that anyways make sense. We have a setup in Europe that is very much driven through incumbent industries for whom it doesn't make such a big difference to pay 27 times licensing fees to get at 450 million consumers. For startups, that may be the end of scaling. And that is what we're seeing, that a lot of those very innovative young companies do go to the US, and that actually may be part of the explanation of the technology boom that we see in the US. So in that sense, I do think we can take the imbalances as an indication that there is a need to address structural challenges, but do good policy measures to begin with. That makes sense, whether in the context of imbalances or not.
Okay, Piotr?
Yeah, thank you. If I may add on imbalances, which is, I think, indeed a very complex topic, and even establishing what is excessive imbalance face challenges. There is, of course, EBA methodology of the IMF, which is like a state-of-the-art, I would say, methodology. But still, you know, there are many assumptions there, and it's a tool that, of course, you know, still probably needs some, and is the process of improving the CBI methodology is ongoing all the time, right? So even establishing what is excessive imbalance face challenges, and then we need to ask what are the drivers of excessive imbalances, which is probably even more complicated task, as we all know that the imbalances are driven by the underlying, you know, the differences and the balance of the savings and investment. But then we need to turn to the drivers of saving and investment in specific countries. We probably all may agree that you know, consumption in the US is too high due to fiscal deficits, due to low saving ratio of the household. Probably savings in China is too high. By contrast, but how to fix this problem with policy actions? It's a very, I think, difficult question, and I think that there is a lot of skepticism whether, you know, policy actions will be made by respective authorities.
Okay, so I think global imbalances has been ticked off. Any other questions, remarks, interventions?
Thank you very much. And thank you to all our panelists by your very, very interesting speakings and opinions. I'm Sixto Muriel from the Spanish Statistical Office. I have more a request than a question for Fritzi. You have mentioned the relevant role of the large cases unit for the production of economic and macroeconomic statistics. I would like you to kindly ask you to elaborate a bit more on your personal vision about the role of the large cases unit in the production of official statistics. For instance, how this work should be strongly led by international organizations, or how statistical offices and central banks can cooperate, given that globalization is a phenomenon with multiple phases, but of course the financial and the non-financial phases are different faces of the same coin. So the cooperation between central banks and statistical offices is clearly needed. Thank you.
Yeah, thank you, Gabriele, for bringing up this really relevant point. And I'm very thankful for this, because that gives me the opportunity to say a bit more about that. Because I do have the impression that large case units are indeed really relevant instruments, and we are seeing a lot of institutions setting them up. And when we look at what they are doing so far, they are focusing a lot on real transactions. And to get a better sense of how corporations actually really work internationally, it would also be extremely helpful to have a better view on the financial side of things, to bring things together and to be able to compare. Of course, this may be challenging, because you may also have to have legal changes in some jurisdictions, pushing this forward, I guess, would be a very relevant task to take on, because we will get a much better view on what is happening. So thank you for mentioning this point.
Okay, thank you. There was a lady in the 7th row on my right-hand side who wanted to ask a question. No?
I would like to refer to the...
Microphone?
I think it's on. I would like to refer to the standpoint by Professor Milesi Fretti. So you said that basically fiscal stimulus in the US and the technology boom leads to the current account deficit there. And I'm wondering, what's your opinion on the status of the US dollar in international monetary system? I mean, do you see any viable alternative for the USD? And if I understood you correctly, you mentioned that one way to decrease the global imbalances is via the USD depreciation. And is it really viable?
Okay, thank you for the question about the dollar. It's something that also strikes my great interest, so I'm listening to your answer.
Okay, so I would cast the answer more in the mold of the geoeconomic risk theme than strictly on the correction of the US current account. So I see a lot of distinguished authors that repeat this mantra that there is no alternative to the dollar. and hence we are not going to see any major shift in global international finance. I personally think that view sets up a straw man. The straw man is the notion that those that say things will change are arguing that we are going to see a major shift in the relative weight of global currencies, that all of a sudden the euro or the RMB is going to become the dominant currency. I don't think there is much support in the profession for that view. But I think that the view that everything that we have witnessed over the past 18 months will have no effect on global finance is frankly quite extreme. What I mean is that considerations of reducing dependence on the dollar or on dollar-based infrastructure, on US-based financial infrastructure, that used to be discussed in the BRICS, fundamentally in countries that geopolitically were either less aligned with the US or in the other camp, are now actively discussed on this side of the Atlantic among US allies that have been hit by a volley of aggressive action on the part of the US administration. And hence, I think that the notion that payment systems are not going to change in the next few years, or at least that efforts to make those payment systems a bit less reliant on US infrastructure, I think that it's very likely that we're going to see developments in that direction. And that's just one aspect of it. Of course, the role of currencies will depend on a lot of other things. It will depend on technology, of course, and on the relative success of different economies. The boom in US tech has clearly contributed to an appetite for US assets. But that is something that is, which you can make predictions. But I think, again, that if we focus on the geopolitical aspect of it, I think the direction is going to be towards less reliance on the dollar than before. And this is because even if this administration goes, the possibility that this type of political choices will be made in the future is something that European policymakers, Japanese policymakers, Korean policymakers, Australian policymakers are going to have to take into account. And the final thing is that, just to tie to the imbalances aspect, the US has a very large negative external position. Some of it reflects equity valuations, which are a good thing for the US economy and for US wealth, but there is also a lot of foreign ownership of US debt securities, and the fiscal trajectory in the US is clearly a worrisome one. So there are economic worries related to certain policies of the United States that add on top of these geopolitical considerations that I just made.
If I can add a practical example to what Gian Maria said, is in times of uncertainty, diversification is a good strategy, very simple. And there I just have to look at and I'm in charge of the risk control of the Bundesbank, so is about really diversification of foreign reserve portfolio. And from that consideration, we picked up the pound sterling in our international reserve portfolio in the recent past. And I say that with a caveat, though, that with some rekindling in our portfolio, the US dollar still accounts for 83%. But I think this general point that it's just a matter of responsible management in times of uncertainty to diversify is a very practical consideration.
A little comment about the dollar from me as well, if I may, because I really believe the dollar is really in the center of all of those geoeconomic tensions that we have right now. So my question, or maybe comment, I don't know how to call it, I just need to spit it out, is the following. I do really believe that it could be a lot less geoeconomical tensions right now if Donald Trump would get what he wanted to get from the very beginning of his presidency, and this was Plaza Accord 2. So Plaza Accord 1 was 40 years ago when President Reagan wanted weaker dollar to strengthen the US economy, and he gathered he gathered influential people from West Germany, France, Great Britain, in New York, Hotel Plaza, and he's just said, since I'm the superpower and you are under my nuclear umbrella and I'm protecting you against Soviet Union, you need to do something for me, and it will be that you will not be fighting back if the dollar get weakened. It will help me, your economy will pay for that, but that's the deal, and they have accepted it. Right now, they didn't. The European Union didn't want to do that. China didn't want to hear about that at all. And this is where all the tensions started. The bilateral trade war between US and particular governments and entities and European Union and the members of the European Union started, and it all erupted. And right now we have geoeconomical tensions. We could have spared it if Europe would cooperate with the US, but they didn't, don't you think? I hope I didn't say anything wrong here.
Do you want to go for it, Gian Maria, or can I just give my perspective, maybe from European perspective? My name is Elsa. I will be in the next session talking about data, but I'm actually from the European Commission. And this is my view now, because we are live streaming, as I understood. No, I think what is also important to highlight in this context is, since we are at the statistics conference, I think it's important to highlight that sometimes statistics are not so easily understood. So the conflict with the US is based on the perception that the US is running a trade deficit, trading goods usually from their perspective, but it's like we have a current account deficit, we are no longer producing within the US, we are importing so much, and so on and so forth. But this current account deficit comes also with a price or with something they benefit from. The European Union or the Euro area allocates a lot of its surplus savings, which it generates due to its current account surplus. They allocate it to the US. Our pension funds allocate the money to the US. Our financial intermediaries allocate the money to the US. And this is also because we, as the European Union or Euro area, also still haven't finished our own homework, right? The single market. We still have a fragmented banking union. We still have a fragmented capital market union. All these things also contribute. So I don't think, I'm not super, like I was a bit unsure about your statement right now, because I don't think it's that easy. I don't think that they fully understood the whole picture, because they are receiving a lot of capital from abroad. But it's a simple balancing item, the current account deficit. So if you run a deficit, you obviously receive savings. Gian Maria.
We may comment on that, but if we don't, we can comment on something else. We are still couple of minutes. We have still a couple of minutes time, so it's a kind of concluding remarks as well. Would someone like to take the floor?
May I? Maybe trying to wrap everything together. I'm not sure if I will be successful in that, but I fully agree with this real versus financial side of the cross-border activities. So it goes both ways, and sometimes the debate on global imbalances is mixing the two, focuses too much on the net current account, and in particular trade in goods, manufacturing, and forget about the services exports that they may be doing to the rest of the world, for example, from the US, or the financial investment they receive from the rest of the world. So that is crucial. But in net terms, again, I'll go back to gross terms. In gross terms, those linkages are huge. We are invested in each other more than you think. So the net is remarkably small, actually. It looks big, I know, so in nominal terms, it's like big flows of money, but the gross positions are big. I know there are some data challenges, let's say SPEs or pass-through capital, or the true economic linkages missing because we just look at the intermediate basis. But nevertheless, we have a lot at stake, and I don't think the story is easy to say, oh, we should have just signed this or that. It's much more than that, and it's again our responsibility to take a step back and look at it from a consolidated perspective. What is the total net gain or loss in our actions, in our positions? Coming back to the international role of the dollar, again, we have a lot at stake because we have big investments there. But again, this is a play between demand and supply, right? The US did big steps to establish the US dollar as the dominant currency. It didn't just happen in one day. The Bretton Woods institutions, the swap lines, the supply with safe assets, the rest of the world, it came over time intentionally. It didn't happen by coincidence. And it can change over time, of course, but it won't be also one day from today to tomorrow. And you need both sides, demand and supply. So the investor should be willing to invest in something else, so switch from US dollar to British pound. Well, they are a small economy, so they should supply more safe assets then, right? But it should, so we should want that, and the supply should be there. So it's, again, a difficult dance on all fronts, real financial and supply demand, I would say.
I would like to take the opportunity of this discussion to pick up one point I made in my comments before, and that is maybe also well placed at a conference where we bring statistics and economics together, that we actually have those asymmetries in even reporting about the actual numbers. No? Are we really talking about a current account deficit or a surplus between the EU and the US? And therefore, I'd like to use the opportunity to really reinforce that concrete recommendation to think about the G20 data gap initiative and add a recommendation to reduce those asymmetries, working together on getting better data in the future to have, because these are politically relevant statistics in the discussion.
Okay, thank you. That's grand, as they say in Ireland. Thank you very much for this wonderful conversation. We need to move on with the conference. There is a very important part ahead of us, which is a coffee break. So I don't want to spoil it with being too much in overtime. Thank you very much. Thank you, and see you soon somewhere. Hope so. Thank you.
So welcome back, everyone, and welcome to this final session of the day on global finance, portfolio flows, and currency exposures. As you can see, we have broken the rules, and I have asked the participants to come with me to the podium. I think the bar is very high. I mean, I think the previous discussion, and I would say the whole day of this first day of the conference is at an amazing level. So I hope we can keep to those standards. So this session will show the four presentations, issues with global financial fragmentation, changes in the international role of currencies, and the increasing volatility in capital flows. So things we have been seeing also in previous sessions. And what I like of the four papers we are going to see now in this session is that they look at these things from complementary angles. And this all fits very well with the common theme of the conference, namely how external statistics are adapting to a more fragmented and geoeconomically complex world. So we are going to have four presentations. I have spoken to all but one. But we have come to the agreement to keep the presentations to 15 minutes. And the idea is to give more time for the last session with your questions. We will have the four presentations in a row, and then is when we will open the floor for possible questions. So keep your questions to the end. And let me now turn to our first speaker, Agustin Venetrix. He is Associate Professor of Economics at Trinity College, Dublin. His research focuses on financial globalization, exchange rates, and fiscal policy, and has been widely published in leading journals. Agustin, the floor is yours.
Good afternoon, everyone. Thank you to the organizers for the opportunity to present this paper here. It's a pleasure to be in such a nice venue. Of course, like other colleagues mentioned before, I'm also thankful for all the work that has been put together through the years in compiling and making data that we users really take advantage of. So thank you for that. So my paper today is called Mapping Global Debt, a new measure of currency dominance and uncertainty shocks effects. And that is a joint work with Berend Demirolmets at the ESM. And of course, the usual disclaimers apply. So our motivation for that is that, of course, the US dollar and the euro dominate global portfolio debt and jointly account for close to 80% of foreign currency denominated debt issuance. The international rules are different. From a dollar perspective, we can claim that it's truly global. 70% of global debt is held outside the US. Well, the euro is a little bit more regional. Over half of it is held within the euro area. Our paper will build on the extensive literature pioneered by Gianmaria Milesi-Ferretti and Philip Lane on the IFA-style measures of internationalization. And what we are going to say is that we're going to propose something new that would try to fix something that is the overstatement of the degree of internationalization, strictly speaking. Of course, in this context, recent episodes like COVID-19, US-China, trade tensions, the war, have increased global uncertainty. And we want to study a little bit more how this would affect the relative role of these currencies. So we identify a missing piece in the study of internationalization, which is being able to isolate the true role of currencies from an international perspective. And what we do, we introduce a new concept which is called a dominance ratio, which sounds more fancy than what it actually is, which is basically compute how much those currencies are used when we pull out of the picture the issuers of those currencies. So we're going to present a paper for a world in which the US and the Eurozone do not exist, but their currencies exist. Understanding currency dominance is crucial, of course, and this venue, of course, has addressed this in many instances. From a point of view of debt sustainability and emerging market economies and developing countries, from the point of view of financial stability, how exchange rate moves and how reevaluations of external positions could be destabilizing, and also from policy planning perspective. So our contribution on this paper will help to have a more accurate sense of the global reach of these currencies, assess geoeconomic fragmentation through the lens of global currencies, international debt, and different measures of uncertainty. 3, to shed further light on the scope of geopolitical influence and sanctions, and improve our understanding on the international role of these two currencies. So we use a little bit of managing different data sets, and we address this from a creative perspective and combine 3 main sources. The focus of the paper is basically on portfolio debt, one item in the IAP, and more specifically, debt liabilities. We all know liabilities are better measured than assets in general. So this will come from the BIS international debt securities. So we would have debt instruments which are compiled security by the BIS and broken down by different dimensions like country, currency, sector, etc. On the holding side, we're going to use mainly 2 data sets. The security holding statistics, also mentioned this morning by Philip Lane in his address, that would include security by security data. And this will be used to be able to factor out the role of the Eurozone as holders of these securities. In addition to that, we're going to bring in the TIC data. TIC data will help us get the role of the US out of this picture in order to address our research question. So we count with a sample of 87 countries that we put in different buckets. Advanced economies, which are the rest of the advanced economies when we exclude those I mentioned before, emerging market economies, developing countries, and financial centers. So for the latter, we use a broad definition, again inspired by the work of Gianmaria and Philip Lane. So you see the United Kingdom there as well as part of the financial centers. So just to give a brief overview, this data basically shows you how the gross stocks of portfolio debt liabilities look like when we take into account that set of 87 countries and we look at who is holding those positions by location and by currency. And what you can see there in green are the US dollar denominated portfolio debt liabilities. In dark green are the holdings by the US. In light green are the holders but not the US, other countries. In blue, different versions of it. You have dark version, which is euro-denominated portfolio debt liabilities. On the one hand, dark version is held by the Eurozone, and the lighter version is held by countries which are not the Eurozone. And what you can see right away is that the share of US dollar-denominated portfolio debt assets held outside the US not only is much larger than the euro, but also grew in time. So this is what we understand by internationalization in the context of this paper. The usage of those currencies when you exclude from the analysis the issuers of those particular currencies. So what do we do with this data? We also first look at the sector, at the geographic composition jointly with the currency composition. On the right-hand side of this figure, we have the issuers, financial centers, emerging and developing countries in Africa, Latin America, Asia, Europe, advanced economies which are not in Europe, like Canada, Japan, and advanced economies in Europe, which are not in the Eurozone. And what you can see there is how much the US and the Eurozone account for the liabilities issued in those respective currencies. So what we will do next is going to put the focus on the green part there, which is the US dollar denominated stock of portfolio debt liabilities held by non-US, and the orange part, which is the stock of portfolio debt liabilities denominated in euros held by non-Eurozone countries. And with those piece of information, we propose the dominant ratio, which is basically the proportion of US dollar denominated liabilities held by countries not the US as a fraction of the overall stock of portfolio debt liabilities in dollars and in euros. Okay, so we basically stripped out from the dollar liabilities the US, and from the euro-denominated liabilities the Eurozone. A value of DR closer to 1 means that the dollar dominates, closer to 0 means that the euro dominates. So what do we do here? We first take a perspective in trying to study as much as possible the dominance ratio. We take a medium-term perspective. We focus on the cross-country variability, and we run a very simple pool regression analysis in which we bring in your usual suspects as the conditioning factors for the determination of currency, of denomination, of issuance. A block that is called finance, one that is related to trade, one that is related to gravity, financial globalization, advanced economies, etc. Okay? So this is a pool regression model in which on the left-hand side we have this dominant ratio, and then we have different set of conditioning factors included following the themes or the buckets I mentioned before. So the first part relates to what the central bank does. So is the central bank of that given country having the US dollar as an anchor or the euro as an anchor? So how would that be related to the fact that the other sectors in that economy are able to issue cross-border portfolio debt in dollar relative to euro? So you see, countries that would have a central bank anchoring to the dollar, more prone to have overall cross-border liabilities denominated in dollars. So this table basically gives you an overview which is kind of very intuitive and expected. Another set of regressors that we have there are potential complementarities through the cross-border links, like, for instance, portfolio equity liabilities vis-a-vis the US. So if a country is issuing debt, another option for a company, for instance, to get finance is equity. So in there, you see in column 2 over there, again, a positive link between the degree of cross-border liabilities vis-a-vis the US and the extent of portfolio debt issuance of that country in US dollars. Okay? Again, we add other kind of well-known regressors, like, for instance, a relative trade to the US versus the Eurozone, oil trade balance. Of course, oil is dominated by euro-denominated transactions, relative distance, etc., etc. And we have a quite expected set of coefficients. So this is not the key takeaway of the paper. Key takeaway of the paper is to focus on another dimension, which is not directly addressing how uncertainty shocks really are able to curb the degree of financial dominance of one currency over another, but looking at fragmentation. To that end, what we do is the following. We take a measure of fragmentation that is basically related to the inverse of the Herfindahl index. We look at the data we showed before, we compute the proportion of liabilities, that are denominated in each currency, and we compute the different levels of fragmentation. The idea here is to see to what extent different shocks would affect the dispersion of these dollar or euro denominated cross-border debt liabilities in time. We take a simple approach. Everything is very simple in this paper. So this is a log-log basic regression model where we have on the left-hand side the fragmentation of each currency, and on the right-hand side we have different kinds of shocks. Shocks including uncertainty, like World Uncertainty Index, as it was mentioned before, economic policy uncertainty, trade policy uncertainty, Caldera's well-known geopolitical risk, and then other dimensions that would factor in global uncertainty on financial markets, like derivative-based VIX, the US equity market volatility, and oil price uncertainty. Of course, this paper is being revised at the moment. We're hoping to get the data closer to today's. We still wouldn't be able to capture recent developments in the world, but it would be very interesting to see how these results I'm about to show you would be in the light of new events. So we have three strategies. The first one is to look at the fragmentation itself, focus on the dollar, see how dollar fragmentation is affected by these shocks. The second approach is to do a horse race, look at the relative fragmentation, basically the difference between how the US dollar is fragmented versus the euro is fragmented. And finally, the third approach is to factor in the systemic role of the dollar. So dollar dominates, there's no doubt about that. So when we look at the relative fragmentation of both, it makes sense to factor in the scale of the two currencies as the currency of denomination for debt liabilities. And this is what you see there as the weighted difference. So this table basically shows regressions in which we first included each of these shocks individually. Column 2 and 3 basically look at the fragmentation in the US dollar as the currency of denomination of cross-border portfolio debt liabilities. Column 3 does the same for euro. Column 1 is the difference between the two. When we take all 87 countries and we compute the fragmentation data index for those countries themselves. What we see there is, first, that the world uncertainty shocks increase fragmentation in the euro, but don't do much on the dollar. Economic policy uncertainty doesn't seem to have an effect. Trade policy affects fragmentation in the euro, but not the dollar. Geopolitical risk, very robust relationship there. Of course, these are reduced form coefficients. We're not claiming any sort of causality. The shocks are lagged one period, but that's as far as we can go there. And what we see is that when we have a spike in this geopolitical risk variable, both distributions of denomination become a little bit more dispersed. We do the same also by looking at different kinds of aggregation. So we look at this dispersion across groups, but I'm going to skip that in the interest of time. Finally, we look at relative fragmentation, but again, factoring in the systemic role of the US dollar. In other words, we use the dominant ratio that I mentioned before to weight the fragmentation variables that we had. And what we see there is when we look at this difference, we see that the relative fragmentation of the US dollar comes up as very important. So that's column 1, and this you have the coefficient of 7%. So 1% shock in the previous quarter geopolitical risk factor increases the relative fragmentation of the dollar by 7%. Conclusions. So dollar debt is global. Around 70% of dollar-denominated portfolio debt is held outside the US. The euro is regional. Over half of it is held within the euro area. From a cross-country variation of the dominance ratio, we find that the usual conditioning factors work in the direction we would expect. It's important to take into account what the central bank anchors is anchored to those currencies, the role of trade invoicing and other links, financial integration, and also distance. In terms of the uncertainty shocks, we find that trade policy uncertainty increases the fragmentation of the euro-denominated debt liabilities outside the euro. Geopolitical risk increases the fragmentation of both dollar and euro-denominated cross-border liabilities. And when the proportion of them is factored in, it shows that the dollar is fragmented more. Financial market risk reduces dollar fragmentation, but not euro. And oil price shocks increase euro fragmentation, but not dollar. So with that, let me stop for now. Looking forward to the questions at the end. Thank you for your attention.
Thank you very much, Agustin. I have the impression that your results, your research will come handy to some of the questions that the panelists in the previous session were receiving. And I think it's a perfect segue to the next presentation, which is also going to speak about another currency, the euro. Our second speaker is Martin Smits. He's a senior team lead economist statistician in the External Statistics and Sector Accounts Division at the European Central Bank. He has extensive experience in international macroeconomics and finance, both in research and policy work. So Martin, over to you.
Thank you very much, Carlos, and I'm very happy to present here today this joint work with colleagues from the ECB's International Department, Roberto and Linda. And as usual, the disclaimer applies, so these are our own views. So I think the paper connects really well to what Agustin just presented. So we also look at the role of international currencies, particularly the euro and the US dollar. But in our paper, the euro area still very much exists. So because we look at the international investment position of the euro area and consider the currencies exposures included there to get a view on the global appeal of the euro in recent years. So I think the context is very clear. We heard a lot about it today already, so that the global currency landscape has faced a lot of geopolitical shocks. There's also talk about growing multipolarity. And at the ECB, we regularly assess the role of the euro in the international currency landscape in a report along various dimensions, so the status of the euro as a reserve currency in global FX markets or in trade invoicing and so on. So one piece of information was still a bit missing, namely the role of the euro in the currency dimension of the euro area international investment position. So I can already tell you that so next week, on Tuesday, the next edition of the International Role of the Euro report will be published by the ECB, and what I'm presenting here today will also be included in a special box in the report, so you already get a preview of some of the results of the report. So our objective is to assess how the global appeal of the euro has developed, and we construct novel analytical indicators for the euro area international investment position. So the main challenge we had to overcome was to find a good methodology, how we can estimate, so because partly we rely on estimates, these currency breakdowns. So to have a look at our, let's say, the dimensions of our final indicators. So as always, when we talk about the euro area BOP or international investment position, we focus on the interactions vis-à-vis counterparts outside the euro area. So we have to have these extra euro area perspective. Then our final indicators, we will be able to decompose the IIP into FDI, portfolio equity, portfolio debt, other investment, and we have a total. So the total does not include derivatives and reserve assets. We have this for assets and liabilities. For the euro, US dollar, Japanese yen, and a residual of other currencies, and we have the data since 2015 Q1. So our main, let's say, input data is the data we receive from the euro area countries, so from the member states. And what we receive from them is the currency breakdowns that I've already mentioned, but for the total positions of the countries vis-à-vis the rest of the world, so not broken down into intra and extra euro area positions. The exception is portfolio debt, where already the breakdown is available into intra and extra euro area components. So the major challenge that we faced was to estimate the extra euro area breakdowns that we do not have immediately in the data. Also, we do not have the breakdown for FDI, but as we receive the total positions, we can derive those residually. Okay, so our estimation approach is quite simple because we receive the total positions, so vis-a-vis the entire rest of the world from each country, broken down by currency. So we receive that. And to derive the extra, we just need to subtract the intra-euro area holdings in a certain currency. So we have to do that for portfolio equity, FDI, and other investment. And we rely on a number of data sources because we cannot observe it directly in our IAP data to derive the currency composition. So for portfolio equity, we use the ECB security holding statistics, which gives us very detailed data, including the currency dimension, and which also fits quite well overall with the intra-euro area portfolio equity positions in the IAP. So it's a good proxy for the intra-euro area currency share. Then for other investment, so first of all, we know that the euro system accounts for around 30% of the intra-euro area positions. These are largely target balances, and these are all denominated in euro, so we already have that information. And for the remainder, we rely on data from the BIS on the locational banking statistics, which also has the currency breakdown. Then for FDI, we do not have such a nice granular data source, so we use the synthetic indicator, which is basically the average of portfolio debt, equity, and other investment. We do some comparison of what we receive here because we have information on the currencies used in mergers and acquisitions. So it's from a commercial database where around 90% is denominated in euro, and this also fits quite well with what we get with our method. So on the right-hand side, you can see the intra-euro area currency shares of the euro. So it's almost 95% in portfolio debt. The lowest we observe in nowadays for portfolio equity, so it's around 85%, but everything is around 90%, let's say. Okay, so with that we can easily then derive the extra euro area positions and take a look at the data. So here you see the euro area IIP. So the total assets and liabilities, the liabilities with a negative sign. The blue bars refer to the euro. So you see on the liability side quite high euro bars, and on the asset side a bit smaller. And what it tells you is that the euro has an important role in the euro area IIP. So 2/3 of the liabilities are denominated in euro, and 1/3 of the assets. The second most important currency is, I think it's no surprise, the US dollar, which you also see in the chart in these orange, yellow bars. We also plot here the net foreign asset position in foreign currencies. So that's the blue line, which is positive for the euro area, which means which is good from a risk-sharing perspective, because it means if the euro is depreciating, this will generate positive valuation gains. So let's say there's a crisis in the euro area where the euro would depreciate, it would generate some positive wealth effects for euro area investors. Okay, so let's take a look at the different components of the IIP and also look at the results over time. So, because our objective was to have an idea about the global appeal of the euro, and so in that sense, looking at the liabilities, so at the foreign investment in the euro area is most instructive. And what we observe here is that the euro share has increased in total assets from around 52% to 66% over the last decade. for the total liabilities, but also across all the components it has, the euro share has increased. So the biggest increase, although from the lowest level, is for FDI, where the share of the euro is now 20 percentage points higher than it used to be in 2015. Also, in portfolio equity liabilities, so now the share has even increased more to 78%. On the asset side, we see a similar picture. Of course, there the role of the euro is lower, but it also has increased for all the components. The flip side is that the role of the US dollar has declined. So both in total liabilities and assets of the euro area, but still the US dollar is the most important currency on the asset side with around 40%. And this mainly reflects portfolio investment by euro area residents in the US. So we all have heard today already about the big equity investment in US stock markets, and that's also very much true for European investors. So let's take a closer look at the expansion in the liabilities. So on the left-hand side chart, you see the value of the euro area IIP and also the share on the right-hand scale. So we've already seen that the share has increased, but now we also observe that the value of euro-denominated liabilities has increased by more than 9 trillion over the past decade. And more than half of that is due to portfolio equity. And also this explains more than half of the increase in the share of the euro. And so what we observe is that this reflects strong global investor demand for euro area equities. So in particular, listed shares are virtually all denominated in euro. So this has a big impact. And then also the euro area investment fund industry has expanded a lot. And even though not all investment fund shares are denominated in euro, a large share is, and this is also a positive impact on the role of the euro. On the asset side, we observe that euro-denominated assets abroad have increased by 6 trillion over the past decade, which is also very high, while US dollar-denominated assets have increased by around 3.6 trillion. So this explains why the share of the dollar has declined, but the share of the euro has increased. Looking at the components, in particular in FDI, there are some interesting developments that the US dollar plays now less of a role. So to some extent, this reflects that euro area investors are more diversified globally in their FDI investment than they used to be. And also, we have already heard a lot about the US multinationals and how they operate in the euro area. And in recent years, they kind of restructured a bit their investments. There were some retrenchments also involving special purpose entities. And I think a lot of the previous investment was, even if it was vis-a-vis the euro area, was denominated in US dollars. So now on both sides of the euro area IIP, so for assets and liabilities, we see that the role of the dollar has declined in FDI. Okay, so then we also made some attempt to explain why the role of the euro has increased. So why is the euro globally more appealing for foreign investors? So without going into too much detail, but we just performed a simple correlation analysis. And so it seems that the share of the euro goes up when there's more, let's say, government debt supply. So if there are more bonds available for foreign investors. Also, if euro area interest rates are higher in relative terms, this attracts more investment into euro-denominated assets. Also, it depends on how much the euro area is trading. So how big the relative share of the euro area is in global trade. This has a positive effect on euro-denominated investments. And I think it's no surprise also if there's kind of positive business sentiment towards the euro area, and lower economic policy uncertainty in the euro area is also favorable for increased investment in the euro area. Okay, so we have this estimation methodology, but we were also thinking, okay, how can we improve the estimates? How can we generate even better results? So the first best solution would, of course, be if euro area countries would also report the currency denomination broken down by extra and intra-euro area positions. So we have tried to achieve this in the new external statistics guideline, but unfortunately it was not super successful. What we managed was that, so we just managed to achieve this week actually in Kraków, that there will be one additional currency, namely the British pound included in the basket of currencies, and which is quite good news, because we know already through our experimental data that for portfolio debt, the share of the pound is around 9%, so it's really the second largest foreign currency for euro area investors, so it's good news that we will be able to include this. So the second best solution would be to have a bit more refined granular data. So the SHS is fitting quite well with the IRP, but still there are some differences where we can have a look and see how we can bridge these differences to have more reliable results. And then also for FDI, our approach is a bit brute force, so there to have some additional data sources, also for the non-bank component of other investment. That would be very useful, but of course, it's not super likely in the short run. Then we are also kind of thinking about the international dimension, and there I'm also looking at Carlos, because I know they have also tried to gather more data on the international investment position of many advanced and emerging countries broken down by currency, and I think there are already very good steps in this direction, but if there would be even more data available, that would be great, also to kind of cross-check our results and to have an even more comprehensive idea about the role of global currencies. Okay, so let me recap on the key findings of our work. So we construct novel indicators, which are really included in the IRP framework for the euro area. So it's really an enrichment for the toolkit for assessing the international role of the euro, also for the years ahead. The key findings are that 1/3 of the assets of the euro area and 2/3 of the liabilities are denominated in euro. And especially on the liability side, we see a dominant and increasing role of the euro, which is quite good news for the global appeal of the euro. And some factors which would help to further increase the global appeal of the euro would be to have a safe supply of euro-denominated assets, and also to have a stable business environment, low policy uncertainty. These factors are of course, very useful. So to further refine the methodology, we mainly will rely on additional data sources or enhanced data sources, but also for that we are quite optimistic. So thank you very much, and looking forward to your questions.
Thank you very much, Martin. We look forward to the publication of the ECB International Role of the Euro in the next few days, including your research. So our third speaker is Okirisa Vivisano from Bank of Indonesia, where he works on statistical development, including digitalization of statistical processes and modernization of foreign exchange data systems. So Okirisa, please go ahead.
Good afternoon to all of you. Thank you for the opportunity to present in this very interesting conference. Allow me to present our paper on using ITRS data to identify persistent portfolio outflows. So I hope you don't mind if we move from Euro area discussion to another side of the globe, to Indonesia. So as a background, we know that global investors tend to respond rapidly to changing economic conditions and policies which can trigger substantial capital outflows that present a risk to an economy. Relevant to our case is portfolio investment liability, or PI liability. This component of the BOP generated net inflows to Indonesia prior to the COVID pandemic. However, in recent years, the inflows have diminished and even turned into net outflows in 2025. This can reduce the overall BOP balance and deteriorate foreign exchange liquidity. In this paper, we focus on the actual fund outflows to learn more about the behavior of foreign portfolio investors, meaning that after a foreign investor sells or redeems their portfolio securities in Indonesia, when would they really choose to repatriate their funds abroad? What economic conditions would predict that? The outflow of funds has a more direct impact on FX liquidity because domestic banks would need to reduce their nostro account positions in order to fulfill the fund outflow as requested by the foreign investor. And we try to study this from a micro perspective in that we look at each investor's transactions and we fit a model separately to each investor. Some related works, Caamaño established that global equity investors' rebalancing behavior is associated with the differential between foreign and domestic returns. And also there's a feedback between exchange rate volatility and portfolio rebalancing. Pagliari and Hanan proposed a model-based estimate of capital flows volatility, and they found that the main drivers of capital flows volatility are foreign interest rates, in their case the US, risk aversion, GDP, and also CPI specifically for portfolio outflows. And Forbes and Warnock found that capital flows have subsided from large waves to smaller ripples after the global financial crisis. Their analyses are based on gross flows, which we also adopt in our methodology. And in their updated study, they found that the main driver of capital flows in recent years is oil price. In our study, our main data source is Bank Indonesia's ITRS, which covers all transactions reported by banks that affect their external accounts vis-a-vis non-resident. Specifically, we use foreign investors' current accounts transaction and also the bank's nostro accounts. We separate between what we call the first leg and second leg of portfolio outflow transactions. The first leg is when the portfolio securities is sold or redeemed or matured, and then the funds is credited to the foreign investor's current account. And the second leg is when the foreign investor instructs the bank to move their funds abroad. For this, we can use either the foreign investor's current account data or the related nostro account transaction. We note that the second leg may not happen at all in the same period as the first leg, if the investor chooses to wait and see or reinvest their funds in other securities within the country. We use relevant information from the data as given here, such as the amount of transaction, the payer and payee information, which is in the free text, so it presents a challenge in the processing of the data, and also the sending and receiving banks to really know whether the fund has really moved abroad, and the transaction purpose to identify transaction related to portfolio investment. The data covers 2018 to 2025 period. Here's the data in aggregate. So the chart on the left is the first leg, when the securities are sold, and we note that the three charts here don't have the y-axis scale for comparison. It's just for depicting the series of each transaction. The middle one and the right one are the second leg transactions. So the middle one is using the nostro account data, and the right one is using the foreign account current liabilities data. Correlations between the three series are small, but more importantly, the first leg is about 15 times larger than the second leg. This probably means that most foreign investors in Indonesia does not do not move their funds abroad when their portfolio investment matures or when they sell it, but instead they rebalance or reallocate their investment in Indonesia. Next is how we process the ITRS data. First, we standardize investor names in the transaction data. This is because our ITRS currently doesn't require banks to use any standardized investor ID or names in their ITRS report. I think this is one of the main challenges in doing this study. It's quite a difficult and subjective process, and so perhaps this can be quite error-prone. However, our manual approach covers about 90% of the total transaction amount. Second, we only include foreign banks and foreign asset management firms in our study to be more specific for portfolio investment. We aggregate the transaction amounts into investor amount separately for the first and the second leg transactions. We are left with 95 foreign investors, which I think may be quite small. Maybe there's some issue here in the completeness or consistency in the data or in our data processing. We then remove investors with less than 10 first leg transactions or for which there's no variation in the repatriation amount, since this will be the dependent variable in our regressions. Typically, this is because there's no outflow activity observed for that investor at all in our data. Finally, we have 36 investors for analysis. Here are some charts of the first and the second leg transactions. We note that the first leg itself is already quite sparse, and the second leg transactions are even more sparse. Due to this sparsity of the activities, probably the regression analysis will have larger standard errors. This is how we test each investor's outflow behavior sensitivity to the macroeconomic factors. Our dependent variable is the amount of repatriation of the second leg transaction R. As a conditioning variable, in our case, is the amount of securities sold or redeemed or the first leg transaction S. Only investor amount with first leg activity within the period or the previous period is included in the regression. So ST plus ST minus 1 greater than 0. This is to answer our research question, which is what are the conditions that would predict actual fund outflow given that an investor sells or redeems their portfolio investment. We use one time lag or 1 month for both R and S as control variables. Now the variables of interest are as suggested in the literature: exchange rate volatility, stock return differential, global risk aversion, oil price changes, domestic inflation, and domestic GDP. For each investor, we will have 95 months of data or less because of the sparsity of the first leg activity. We run a separate regression for each investor to get their individual behavior, so this is not a panel regression. We use OLS for the estimation, but we also double check with PPML regression because the outcome variable is bounded below by 0. And here are the results. So in this table, for each macro variable, we count how many investors out of the 36 that have significant effect on the macro variable against their repatriation behavior at 95% and 90% confidence levels. We observe that GDP, risk aversion, and oil price are the macro factors most associated with fund repatriation. This is in line with the literature that we cite in recent work section. Average R squared across investors is 0.27. For fixed and oil price, the sign is quote-unquote correct in about 3/4 of the investors, in that high risk aversion and higher oil price changes is associated with an increase in repatriation. On the rightmost column, we also present significance result based on machine learning and sharp variable importance methods. We find that again, fixed and oil price are the most significant, as well as inflation. So the regression and machine learning methods somewhat disagree on inflation and GDP, but this could be because the machine learning model that we use could capture the nonlinear relationship between macro factors and the repatriation behavior of foreign investors. Finally, we also observed that lag repatriation is significant with positive coefficient in many investors, and this may indicate persistence of repatriation behavior. Okay, last is some future works. So from the point of view of the study, it will be very helpful if the ITRS data contain standardized investor ID across all investors, all banks, and all transaction types. The data preparation process would be much simpler and less error-prone. We would also like to try predictive models to actually nowcast or forecast repatriation at investor level, which would be useful, for example, in scenario analysis. That's all from us. Thank you. We look forward to questions.
Thank you very much, Okirisa. Some of your results are really shocking, so I would like to have the opportunity to ask you more in the next round. But before that, I would like to turn to Ersa Arukah. She's economic analyst at the European Commission's DG ECOFIN, with extensive experience in balance of payments and external sector surveillance. And she's now going to present today the revamped FinFlows dataset.
Okay. Thank you very much. Okay. So my name is Ersa Arukah. I work for DG ECFIN in Brussels, but before that I used to work for the Austrian Central Bank, actually, 10 years in the macro statistics department, so I have strong feelings for the statistical world and a strong appreciation for it. So what do we do at the Commission? Of course, we have our main tasks in the surveillance of the economies, but for this we need, or let me put it differently, in order to do a good job, we need evidence-based policy. So evidence-based policy means we do not look, because we had the discussion a bit earlier, at what are our policy needs and how can we adjust the data, but we try to do it the other way around. What does the data tell us and how can we implement good policy? So we decided to revamp the FinFlows dataset, and together with my co-authors, Leonor Coutinho, Serena Faccia, Matteo Saito, Stefano Ungaro, and Stefan Zeugner from the Commission, we are in the final stage of preparing them. So as said, we have a lot of motivation to do so. For us, it is important to have a coherent data set. First of all, to assess financial interdependencies, spillover, systemic risks. All these topics were covered during today's sessions in one way or another. However, this is not so easy. We want to provide, we as the Commission, we want to provide granular data, consistent data, and timely data, but we do not want to reinvent the wheel, because our colleagues, also especially in this room, are already doing the work. But what we are trying is to put all these puzzle pieces together into one big thing. All this is, of course, based on ESA 2010 and BPM6. And as said, we want to do evidence-based policy. And we want to contribute, for example, to the macroeconomic surveillance of imbalances, of global imbalances, for example, as we discussed earlier, of also within the member states, we look at the macroeconomic imbalances in the procedure. We want to see the financial stability assessment made easier, but also from a bigger picture perspective, the Savings and Investment Union is now very popular again, also in Brussels. So we are trying to assess that and approach this perspective also by looking at the data. So what does the data indicate? How can we make things better? And of course, all this is affected by potential impacts of geopolitical uncertainty, which we heard already today. So FinFlows already exists. It was created over 10 years ago by Stefan Zeugner, one of the co-authors. and he created an annual database, but focusing only on the cross-border exposures. He created it for stocks and positions. He created it on the old methodology, so BPM5 and ESA 95, which is quite impressive from my perspective. And he also provided the data to the public. But it was very old methodology, and it was very slow in the compilation. So we decided to revamp everything, also based on all the granularity and all the progress which was made by the ECB and Eurostat over the last decade. So what we will provide to the world, not just within the Commission and within our institution, is a quarterly who-to-whom domestic and bilateral exposure data set. This means we have more or less the classical view by economic sector or institutional sector, by functional category of the balance of payments, and the financial instrument. So I will quickly guide you through the methodology. What is covered? When we look at the balance of payments and the IIP, we usually look at it from the perspective of the functional category. This is the classical view. What are direct investments? What are portfolio investments, other investments, reserve assets? Sometimes we take a step further and we say, okay, within foreign direct investments, what about debt instruments? What about equity? However, we wanted to have an even bigger picture. We wanted to combine all the benefits of the sector accounts with the balance of payments and create a huge thing. So what we will provide by the end of the year, this year, is we will provide all the institutional sectors as total economy, if you're interested in the bigger picture, but also split by the government sector, households, including NBISH, non-financial corporations, and the financial corporation sector. And even within the financial corporation sector, we put a lot of effort into splitting the sector. So we have the bank, meaning central bank and deposit-taking corporations, and the split of the two. We have the investment funds. We have the insurance corporation and pension funds, which have gained a lot of prominence recently once again. And we have the office. And I think based on the discussions that we heard earlier, also about the FDI and the role of FDI and geopolitical fragmentation, and also the role of MNEs and all these globalization topics, it is important to highlight that this is actually pretty cool, because we have the other financial institutions, which also include the SPEs, and also are used as vehicles to allocate capital, right? So the connection between the non-financial corporations, S11, and the other financial institutions or the office is very important. And based on our data set, you can see it on the first, like at first view, without digging too deep. We will cover most instruments. We have dropped the currency for the final product, but we couldn't drop it during the compilation of the data set, obviously, especially for the central bank. We cover debt securities, we cover loans, obviously with the maturity perspective. We cover listed shares. We have taken upon us the very specific task of trying to estimate unlisted shares and other equity, the total of 51M, where it's not available. I will get to that in a minute. We also look at investment fund shares, which are very important, also as Martin recently showed, about the role of foreign investors allocating capital towards investment fund shares within the euro area. We also look at insurances and pensions, funds or pension entitlements. We look at trade credits and, of course, other accounts payable and receivable. What is covered? We try to cover as much as possible. We cover the EU member states, we cover the euro area aggregate, we cover the EU aggregate, obviously, also the EU institutions, we cover the OECD member states, but we also cover major non-OECD countries. This comes with a price. The larger the country and the farther away from Europe, the more aggregate the information is. But nevertheless, we wanted to provide as much as possible, like all this different available data into one data frame, and this is one of the results. And what is also very nice, it is covering the entire timeline starting in 99 Q4. And it's also on quarterly basis, which gives researchers and economic analysts the opportunity to have many data points and to see what is going on. On the right-hand side, you will find a table that you will find if you visit the webpage of the Central Bank of Austria, actually. We adopted this view from them because it's the reason why we are doing this exercise is also because I have a strong background and the experience coming from them. And they were one of the first to unite the units on the sector accounts, financial sector accounts, and the balance of payments. And based on that, we are able to manage all the financial instruments, which are listed on the left-hand side, with the functional categories. So if you are interested in looking at portfolio investment, you will be able to look at the portfolio investment in total, portfolio investment bonds, but you will also have the opportunity to say, you know what, actually I only want to look at equity components, regardless of the functional category, and have the information, which is a nice view because you are then able to switch between different perspectives, which helps with the evidence-based policymaking. How do we get there? Everything is programmed in RStudio. We have a specific package that we use because we need to work in a very complex multidimensional perspective, or like a data cube. And it's called MD-Stats and was created also by Stefan Zeugner. What is very special here is we only use data that is publicly available. So what we want to do is use information that exists, that was compiled by the member states, and that we can further use and enhance. And we put everything on GitHub. We are very transparent, also in our programming time still, without the final code being done. We put everything on GitHub because we want to be as transparent as possible. People can challenge it, people can use it, and based on that, continue their work as long as they decide who did the first step. And we want to automatize the process, also with the help of different AI models. We want to make sure that this is coherent, that this works, and that there is no need for someone like me to sit like once a month down and try to program or solve any issues if there are technical issues. Just a quick overview for the sake of time, so we have a bit more on discussion. But what we try to do is we basically have a set of Legos. And what we try to do is use them as building blocks. We start with the most important one in our view, and therefore thank you for the invitation to come here to present it, with the ECB QSA data, because it's a nice starting point for the domestic exposure, but you also have the off-which positions, for example, for FDI. It's already quite coherent. It's also the euro area aggregate already is bridged to the balance of payments perspective, so the cross-border perspective. So you have a very strong foundation, and you have it for all EU member states. We then go back to Eurostat and take the sector accounts on annual basis, sector accounts on quarterly basis, BOP, IIP, all the information that is available, also with counterpart information, and fill the gaps. You just have to think about it like a matrix that we try, like we have a lot of NAs, and what we do is take different sources and fill the gaps as good as possible. Then we take further steps. We go to the balance sheet item statistics of the ECB. We take the information from there. We go to the security holding statistics. We take the information there. Then we do some economic assumption and some calculations that I will quickly talk about in a minute. And then we only at the very, very last step, we go to the international organizations that are on the other side of the Atlantic and take the IMF data. Before that, we also use OECD FDI data. We use the BIS banking data just to close the gap, especially the regional gaps. But only at the very, very end, we go and take the portfolio investment and direct investment data by the IMF. As you can imagine, we face a lot of difficulties. I will quickly talk through two important parts. But one major thing that might pop up when we have the discussion is what about the bilateral discrepancies? So this is our big project during the summer. There is a lot of thought going on into how to close these discrepancies. And in the end, it will be more or less like a dynamic ranking where we say we trust this data source a bit more than the other one, just to be able to bridge the gap. We are not, as said, data compilers. This is not our main approach or main aim. But what we do is we try to create a coherent framework and data set that can be used by users, especially us. So some of the special treatments or like some of the special calculations that were needed are intrasectoral exposures, which was quite straightforward because you have the annual sector accounts and the quarterly sector accounts, and then you do the magic to residually calculate the intrasectoral exposures. And as indicated, the unlisted equity was one of the biggest challenges because we have a lot of information on equity as a total. We have a lot of information on equity on listed shares, but the more complex approach was how to calculate unlisted equity. So you might think, okay, she's talking about the domestic exposure, but this is external statistics. Where is she going? So in order to have the bigger picture for the cross-border exposure, we also need to be able to know how much is happening within the economy. So for us, it was important to be able to calculate that and to understand the exposure within the economy in order to be able to tell a story about the cross-border perspective. Other instruments were relatively easy. Trade credits, if we don't have any information, we allocated mostly towards non-financial corporations. Other accounts, if we didn't have any other information, and this cell was also put on not available, we allocated to the government sector, and insurances and pension claims we allocated to the household sector. So some preliminary results, and I would like to highlight the word preliminary. We are still working on the data set. It's not perfect yet, and there will be even more granularity by the end of the year, also for the public available. But here's an example for Hungary. We have a who-to-whom matrix, or whom-to-whom flowchart for Hungary, and it shows all these instruments that I was talking about. It shows the deposits, the bonds, the loans, the equity components, the insurance and pension entitlements, trade credits, and also investment fund shares. And this is a nice example because it closes a bit my presentation by showing you a bigger view. You see on the left-hand side the creditors, and you see that the rest of the world is a very important source of capital for the Hungarian economy. And when you look to the right, you see that a lot of this capital is actually allocated towards this other financial, towards the office. And this is also something that we will be, or we are able to show now at one point, or like at one view. We can show the entire connection with the rest of the world, and also in the final product, we are also able to split the rest of the world to say how much comes from the US, how much comes from China, and so on and so forth. But you have like one view on how the different institutional sectors are exposed to the rest of the world. You have the ability to drop down all this information to say how is the connection changed if I only look at debt securities? How does the information change if I only look at listed shares? Obviously, some sectors drop out. But it also helps us to understand, and this is what we did, for example, in the last autumn package for the European Commission. We wanted to understand and make it a bit more feasible. We always talk about the current account surplus. We talk about that we allocate so much capital towards the US, but how does this actually happen? So what we were able to do based on the data set is, okay, the biggest contributor from net lending perspective are households in the EU. And they allocate most of their savings towards financial institutions, not just banks, but also insurances and so on and so forth. And on the next step, which is more or less a pass-through that we were also discussing, these institutional investors allocate this money abroad and mainly to the US. And with these closing, I think these are nice closing remarks, and we can go to the discussion. And I would very much thank you for your attention. Thank you.
Thank you very much, Ersa. So indeed, now it's time for questions. So I have a battery of questions myself. Don't take this as a threat. So I will look around first. Yes, Jean-Maria, and here, and then I think, Olivier, you wanted to ask as well? Okay.
Thanks. Yes, thanks all. 4 great presentations, super interesting. A couple of questions for Martin. First, on the pound sterling, is it basically Irish and Luxembourg money market funds that account for that? That is, they basically the money market funds in the UK, sterling money market funds are Irish and Luxembourg funds. Presumably they hold UK short-term sterling financial instruments. So if that is the case, I wonder, I mean, it's certainly interesting to do the breakdown, but if you think of currency exposures of the euro area, it seems as something that nets out from a practical perspective. Presumably those funds are also denominated in sterling. The second question, maybe a bit less nerdy, is how do you think about currency of denomination of FDI abroad? So if you own a factory in country X, what is the role? I can see for certain aspects of FDI the relevance of the currency of denomination, but otherwise, is it just an accounting convention? Or and if I may, I wanted also to say that fascinating work on the financial flows. Was just wondering for Hungary. I know they have a lot of SPEs, an enormous amount in FDI, and does that account a bit for what we are seeing there? Okay, thank you.
Okay, perhaps we collect a couple of additional questions there. So first Olivier and then George.
Thanks, Carlos. And I also have one question for Martin, so apologies for this, but it's a very simple question, basically. So you compare 2015, 2025. Now, the financial condition and monetary policy completely changed between 2015 and 2025. So I guess valuation effect might be there as well. So I'm wondering, if you add some robustness checks, especially when you value securities, debt securities, and you compare market value versus nominal value, for example, if this changes actually the picture that you were depicting. Yeah, thank you.
Well, thank you very much for the nice presentations. I have a question for Agustin. It relates to the fact that hedge funds domiciled in Cayman have been now purchasing a lot of US treasuries. That in turn, these hedge funds are owned by US residents, and this has been driving a lot the increase of US treasuries liabilities. I would like to ask you whether you account for this and how would that change your results?
Thank you, George. So we have questions for Martin, we have questions for Agustin. So let me complete with a question to each of the other two panelists. So for Okirisa, as I said, I was very surprised to see that the data suggests that securities sales by foreign investors in Indonesia are roughly 15 times larger than actual fund outflows. I think you explained in your presentations that this is mostly reallocation or rebalancing in Indonesia, but I would like to know more details about what are these investors doing with the money if they are not taking it out of Indonesia. And then for Ersa, you are not a statistician, you are a user, so although you have a mixed soul, I guess. Okay, so my question to you, more from the user angle of it, is what policy question can you now answer with inflows that you couldn't answer before? And to be more specific, has the data set already revealed anything surprising about financial integration within the European Union? So we start with Agustin and go in that direction.
Very good. So first of all, thank you for the very good questions. So in relation to Cayman Island, so this is a perfect opportunity to flag the shortcomings of research which is reliant on residence principle as opposed to consolidated. Of course, Cayman Island is very much linked with the US, and here, as we showed in the paper at the beginning, the big chunk of US dollar denominated debt liabilities is basically issued in financial centers. So the paper, as is, doesn't account for that, so that's a good point. In order to consider this kind of indirect effects of pass-through economies, what we've done was to look into the fragmentation broken down by different types of countries, and we looked at financial centers excluded from the sample. I didn't discuss that much today in the interest of time, but that's a very good point. And again, you know, just to stress how important it is to make the difference between residence base on the one hand and consolidation, in particular when one has in the mix of countries pass-through economies like the offshore financial centers. But yeah, good point. Thanks.
Thank you, Jean-Marie and Olivier, for the very good questions. So for the role of the British pound, yeah, I think to some extent you're right. So we know that there's this fund industry in Ireland, especially, that is then investing in British assets or British bonds denominated in pound. So this number I was quoting for portfolio debt, we construct based on SHS information. So meanwhile, we are interested at the euro area as a whole, we can go more granular and really see where it comes from. But so as we would like to collect the data not only for portfolio debt, but for all the components of the IAP. So I think in other components we would not have, to such extent, these kind of pass-through or look-through exposure. So I think, yeah, as always with the euro area data, you have to be very careful and how you interpret it. So I think you're right here on the portfolio debt. Then on the FDI currency denomination, yeah, it's a bit of a strange concept. So I think in the early work, which was done by Philip Lane and then also by Agustin and me later on, we assumed that all FDI assets or liabilities are denominated in the currency of the destination country. But if you look at the data, you see that that is not the case. So so there is something which I think is related to, especially to multinationals. So the way how they operate, or also that the investing country kind of wants to lend to its foreign affiliates in the domestic currency. So I think probably the way it's constructed is that you look at the initial flows. So for equity, let's say you buy a listed company, then this investment would be denominated in some currency. So you could take that, and okay, for unlisted equities, maybe it's more of a convention. But if you do like intra-company lending, it will be in a certain currency. So it's really probably hard data. On Olivier's question, yeah. So far, because it's kind of a first step, we just followed our IAP data. So we looked at market values and didn't really try to break it down more, let's say, into nominal values to see, or also into flows or valuation effects. So far it's only for the IAP at market value. But yeah, I think you're very right, and also some of the results that we found that interest rates play a role, and then interest rates in turn would also affect valuation of debt securities. So I think there's definitely something there, but yeah, so that's a bit let's say, for the next step or for future research.
So for the first question, yes, and the OFI sector includes also financial SPEs. We haven't done the split yet, but it would be also easily possible for users just to use this data set and the information, for example, provided by the ECB and go ahead and do analysis, so that would be no problem. Maybe we will also include that, but I haven't discussed it fully. I don't have in mind if we haven't made a decision yet, if we want to flag it also already in our published data set, but it includes financial SPs. And on the policy areas where it can be used, I think it can be used for many things. It can be used for the Savings and Investment Union, as said, because it shows us a lot of insights on the savings and investment gap, which is the current account balance. So if you save more than you invest in your economy, you have a surplus, and the other way around, you have a deficit. And it tells us about the economic sectors and also instruments playing a role. So it can give you a lot of options on policy response and potential risks analysis and so on. And the other thing is, and something that we also try to promote internally and externally, is about the role of the Capital Market Union. Because we think this data set also shows us that there is a lot of things that we still have to do on European level. The Draghi report, for example, also highlighted that there needs to be a way to use European savings that flow abroad on an aggregate level speaking, and how can we use those private savings, more or less, to finance European investment needs. We have a lot of challenges going ahead, so this would be one of the tools, how to use it, how to also track if progress is made, to be honest, also to see if the policy that I implement also has an effect. And there was also a result, a surprising result for more people more than for others. For example, we did for the European Macro Report, which was published for the first time last autumn during the autumn package by the European Commission. In Chapter 3, we looked at the allocation of household savings, so the financial savings, how they are allocated immediately, which is the classic view, as indicated earlier. Most of the savings remain in the financial sector, a little bit maybe goes abroad, but the picture is stable and looks the same like for the positions and stocks. However, if we use this information and see how the pass-through via financial intermediaries has affected those savings in 2024, we saw that around half of the savings actually in 2024 went abroad. So this gives us a lot of potential to discuss also within the European Commission, but also with researchers and other stakeholders, because it gives insights that you might not track immediately. Thank you.
Thank you, Carlos, for the interesting question. So I think this could be an artifact of the data. First, we couldn't be 100% certain that the banks report ITRS transaction perfectly and completely. Or maybe the banks use different tax formats or different names for foreign investors between the first leg and the second leg transactions. So there's that could be an issue about the data. But we surmise a more likely explanation is that it's the security selection process by foreign investors. So every time a foreign investor wants to move their funds from stock A to stock B in Indonesia, or from stock to a debt securities, it will be recorded in the ITRS current account data, which is our first leg data. But the second leg might not happen at all. So there will be no record in the Nostro account data or fund outflow from the foreign investors' current account data or the second leg transactions. That's probably why the first leg is much bigger than the second leg. It could be just the security selection process, although we haven't really looked at the data in even more detail. Thank you.
Okay, very good. So we have a second round of questions. I see Venkat over there and here in the corner next, and then another one. Well, we have already 4 hands. Let's start with Venkat.
Thank you, Carlos. Thank you for very nice presentations. And certainly one of them is on my favorite topic. This is from Erja, tracking financial interconnections. I can understand that what you are talking is basically about from whom to whom sectoral positions, okay, and certainly that is a topic which is really of great interest for us. And you may be aware that we have been doing work on balance sheet approach, which IMF calls it a balance sheet approach, obviously. This is from whom to whom sectoral accounts. So I really appreciate all the work that has gone into putting together this kind of beautiful data set, which is very complicated, as you explained, and which is going to be very important. So I have some one, two questions on this. For example, certainly it might have been difficult for you to map this direct investment from functional categories to instrument classification, which you explained. Okay, that is very difficult. I am not going to ask you how you did it and what is that. But what I am going to tell you is that in BPM 7, direct investment data is going to be available for you by instrument and sector, so that that difficulty which you might have faced, that we will overcome. One of the reasons for that is for developing this kind of data set. We said that balance sheet approach is something very important, so we have to have direct investment by instrument and sector. Okay, that is just for your information. And questions relating to questions are basically, you mentioned that you have also, this database also covers some OECD and other some big non-OECD big countries. For example, some OECD countries like Canada, my colleague is sitting here, Emmanuel from Stats Canada. So I understand that they already prepare from whom to whom sectoral accounts, positions. So did you get a chance to validate the data or preliminary results with them, how they look like? So if you have any differences, are you accepting their own data, or what you have done that? That is one thing. And other one is that you mentioned another difficulty you had certainly is about unlisted shares. Certainly appreciate that. Certainly that is a very difficult item to estimate. So in BPM 7, again in 2020 SNA, we have reduced the valuation methods for unlisted equity from 6 approaches to 3 approaches. So I'm curious to know which approach you applied, whether that approach is uniformly applied across the countries. Thank you very much. Yeah.
Okay, so this gentleman on the right.
Previously, I didn't introduce myself. My name is Levente Foludi-Orsag, and I'm an undergraduate student at Bocconi University. Now, my macroeconomics course came to a conclusion recently, and the last topic I studied was government debt, specifically the evolution of debt to GDP ratio. So I have a question for you, Martin. And the question is, can greater euro area government debt supply strengthen the euro in international, so strengthen the euro's international position without raising debt sustainability concerns when the real rate of interest is greater than the economic growth rate? Thank you.
Okay. I have Robert here, and then there was another question at the end. Okay, and then we close this round.
Yeah, many thanks. I have a question to Azar, and in particular on terminology. You used very clearly the point on evidence-based policy making, and here I would like to say very different from author to author, different things are meant by that. So I understood from you, you would like to be inspired from the data and then also to derive certain policy measures. Some other authors put in addition as a kind of evidence-based policy making that directly in the relevant regulation for putting in place and for putting in all these measures in place, then the aim of influencing a certain target, a statistical target, is mentioned explicitly. That's the second thing. And even more, some others say then, in addition, afterwards, evidence-based policy also automatically includes that an evaluation takes place afterwards, and then to take the conclusions and based on that. Right? So I was a little bit lost in which way evidence-based policy is used in your presentations. Thank you.
Thank you. Just a quick question for Agustin. You mentioned that 70% of US debt is held by non-residents, if I understood correctly, and that makes it a global currency, whereas 50% of the euro area is held by non-residents, making it a regional currency. So I'm wondering what's the threshold for the euro to become a global currency? Thank you.
Okay, I think this will definitely be the last round of questions, and I think everyone has at least a question about Okirisa, right? So let me ask you a second question. So I think your regression and machine learning models disagree on some drivers, and in particular for GDP and inflation. So my question is also very specific to you. Which of the two you trust more for policy purposes? So we start again in this direction. Agustin.
Very good. So thank you for the question. I suppose here a caveat to flag before addressing the threshold question is what subset of the overall global financial system we are looking at. So here we're just focusing on one type of instrument, that's portfolio debt. We're also looking into a subset of countries, which are 87 countries out of the world. So in that context, you know, there's no such a threshold to be referred to. The language we use in the paper is basically in relation to the proportion of overall portfolio debt issuance, which is basically issued and held outside the country that basically issues that particular currency. So unfortunately, I don't have an answer to the threshold question to put a number there, but just to flag the angle that we're giving to the paper, which is not a comprehensive one, looking at all instruments or functional categories, but just looking at a subset, which is portfolio debt. Thank you.
Yeah, thanks for the very good question. So, yeah, I'm not saying that having more government debt as such would increase the role of the euro. So I mean, what we did was, so it's kind of a backward-looking study, of course. So we've seen in the past if the relative supply of euro area government debt compared to other advanced economies, government debt has increased. So that has kind of had a positive impact on euro holdings by foreign investors. And then also, of course, you need to look at the composition of the, how this government debt would look like. So of course, it should be, let's say, if it's highly rated, these are highly rated bonds, or also these EU bonds, which are kind of seen as safe assets. I think that's kind of something which where foreign investors have a big interest in diversifying into. So also compared to let's say US dollar denominated government bonds to invest into safe euro assets. But so it depends a bit on the global environment. So that's why we have this relative measure, and also at the type of government debt. But so it's no encouragement for governments to issue more debt, and then the role of the euro would increase. So that's not what we meant here.
Also, from my side, thank you very much for the feedback and also positive reaction. I'm happy to report it back. And I'm also happy to hear about the progress that will be made with BPM7. However, there are still a couple of years until we have this nice new treasure. So we needed an intermediate solution, and we did our best in creating this data set. I mean, obviously, it's not as good as a member states compiling the data and having the micro information, but we tried to do as much as possible, as said, with the already available information, just to make sure that we really don't manipulate the data too much to adjust it to our needs, but really see how much can we derive also for the unlisted equity, not just unlisted shares, but also other equity, as much as possible. We have totals, we have the distribution among sectors, how much can we derive from that information without playing too much around with the valuation, for example. And the other thing is, thanks to our colleagues at the ECB and Eurostat, we are also able, because we start from the sector accounts and we have the financial instrument split, and also in the sector accounts of ECB QSA, we have the of which position FDI, for example. It is relatively easy from there to then fill these data gaps with other sources like from Eurostat and so on and so forth. And also the functional categories at Eurostat and like the SDMX codes always end with or usually also include the financial instruments. So the mapping was not easy, like it takes a lot of lines of coding, but it was manageable in the sense that we have the information. Now the next big step is just to make sure that it's coherent also within the or between countries. And to the terminology, I think it's both, or like it's a bit of everything that I was trying to say, and there is no strict definition that I'm applying. The thing is, from my perspective, it is important to also track a certain legal decision that was made a couple of years ago and that has impacted also economic or macroeconomic developments. Did it achieve what we thought it would achieve 5 years ago? And that's also a bit the thinking of this evidence-based approach, because sometimes maybe the results that we see based on this data set will not make everybody happy. Because they maybe thought, oh, okay, we thought that certain policy measures or certain legal frameworks would change that, but it didn't. So what does it mean? So it's also a bit of a, like self-reflecting opportunity, if I can say it like that. But many thanks for the nice feedback.
Thank you again for the question. I think I will trust regression more, because that's what everybody's doing in the literature. On a more serious note, it's because in this study we have a problem for identification, so for like variable significance. So I would believe regression more in this case. Unless we're already moving to the predictive part of the model, then we'll definitely use machine learning, because it could capture non-linearity in the data. Thank you.
Okay, thank you very much. So I think this leads us to the end of the first day of the conference. I hope on a very high note. And let me join me in giving a big round of applause to the 4 speakers. And I guess next is a meeting at 7:15 was in the, and perhaps you can give us some advice about the dress code.
Okay. Yeah, I'd like to remind that buses will wait at 7:15 in the front of the hotel. Moreover, after the dinner, one of the buses will have a stop in the city center, close to the old town. So all the people that they are located in the hotel close to the city center, please follow the sign, and our team will assist you to find the right bus. As far as dress code, I think we should feel as comfortable as you would like to. So the tie is definitely not needed for the dinner. Feel comfortable. Yeah, thank you.